Good afternoon. I'm Jim Stock, and on behalf of myself, my co-editor, Jan Eberle, and the Brookings Institution, welcome to the Spring 2022 panel of the Brookings Papers on Economic Activity. As always, we are grateful to Brookings for all the work they do to arrange the program and to make this whole operation work. This is a Zoom conference, so let me explain some logistics. Authors have 15 minutes. Each discussant has 12 minutes. We then open the floor for discussion. Participants, please raise your hand and we will call on you with unmuting, or you can put a question in Q&A and we will read it. The conference is being live streamed with a link off the BPEA website, so please bear this in mind since it's world viewable. We have 3 papers this afternoon and a panel plus 2 papers tomorrow morning. Each day after the sessions, we will have 3 breakout rooms, 1 for each paper or session. This afternoon, you will be emailed links at 4:40. Just choose whichever you want for a breakout room. The breakout sessions will open at 4:50 and will close at 5:30. With that, let's turn to the first paper, Monetary Policy and Racial Inequality. Presenter is Paul Wachtel.
Thank you very much. Thank you, Jan and Jim, for inviting us. Thank you to my co-authors for giving me the opportunity to work on this topic. And thank you to Brookings. It's a pleasure to be back at a Brookings conference on economic activity. I was here, not many of you might remember, in 1972, exactly 50 years ago, the spring 1972 conference. And didn't at that time imagine I would be back 50 years later, but it is indeed a pleasure. Let me share my slides and get started. Okay, and I'm even going to start my timer. Our interest in this topic was motivated by the observation that 150 years after the end of slavery in this country, racial gaps in both income and wealth are astonishingly large. Moreover, in recent years, there's been an increased research interest in the idea that macroeconomic policy, monetary policy in particular, can have distributional effects that might matter and are worth looking at, which has led some to argue that with regard to racial inequality, policy has a specific task to play. Perhaps this is campaign rhetoric, but back in 2020, Biden said that the Fed has a profound impact on our economy. Its existing mandate promotes maximum employment and stable prices. The Fed should add to that responsibility and aggressively target persistent racial gaps in jobs, wages, and wealth. Well, that might be a bit of campaign rhetoric, but even somebody as grounded as Chairman Powell acknowledges that maximum employment is a broad-based and inclusive goal. So that leads to our task, which is to investigate the impact of monetary policy on racial gaps in income and wealth. What do? We estimate the effects of monetary policy shocks on racial unemployment and wage gaps and on asset prices. We link those asset price changes to the portfolio gains of Black and white households using the Survey of Consumer Finance's data. And then we make some comparisons between the earnings effects and the effects of monetary policy shocks on portfolios over different time horizons. We find that an accommodative monetary policy reduces the unemployment gap, which increases earnings of Black households and relative to white households. At the same time, the shock effects asset prices with different impacts on the portfolios of Black and white households. The wealth gains from an accommodative policy shock overwhelmingly benefit white households. So while monetary accommodation reduces racial income inequality slightly, it widens racial wealth gap significantly. We can see some of the differences that are relevant in the data. This is the 2019 Survey of Consumer Finances. Black households' median holdings of equities, housing, and bonds are 0. The wealth gaps are proportionally larger than the income gaps, which are large as well. The differences in portfolio shares are shown in this figure. They're large. The equity share of white households is about twice as large as that of Black households, and the housing share about a third higher. These differences in portfolio composition give rise to different exposures to asset price changes and very different changes in wealth when asset prices are changed due to a monetary policy shock. So let me move on to what we do in brief. Step one is we identify the monetary policy shock using the Romer and Romer methodology, which is to define the shock as that part of the change in the funds rate, which is orthogonal to the Fed's information set. This is a widely used approach to identifying a monetary policy shock. We then estimate the effects of these shocks on asset prices and on the labor market with a linear projection instrumental variables approach. We apply those, in step two, we apply those estimated asset price changes to the Survey of Consumer Finances household data to determine the portfolio and what we call the capital income effects of the monetary policy shock. And we also at the same time use the estimated labor market effects of the shock to determine the monetary policy shock's consequences for the earnings gap. And in step three, we make some effort to compare the earnings and portfolio effects over time. The empirical setup is given here. I won't dwell on it, but let's take a look at the shocks over time. The asset price effects are large and in some cases persistent. The effects on the labor market, which are the two at the upper part of the figure, show that monetary policy shock has an effect on the unemployment gap, but doesn't seem to have any significant or consistent effects on the wage gap between Black and white earnings. So let's take a look at our results and what all this implies. I'll deal with the assumptions when I need them, but the key results are shown here, which is the capital gains for Black and white households from a policy shock. We need to take some of the effects estimated and make some assumption about duration using average duration figures from Bloomberg to take an interest rate change as to the effect of the policy shock on some interest rates and convert that into a price change on assets. But with that duration assumption, we are then able to look at the price changes for all assets and infer the capital gains for the average household over a 5-year period. And as you can see, they can be quite large, and the difference between the capital gains experienced or received by the average white household, are always much larger than the capital gains received by the average black household. That is, of course, due to the fact that white households tend on average to be wealthier to begin with, but also because the composition of assets held by the average white household benefit more from asset price change. Now, to correct a bit for the distribution of households across wealth, we look at just those households around the median, those in the 40 to 60th percentile in each group. And here you see that for households around the median, excluding all the wealthy households, the average capital gains are much smaller. The scale here is very different than it was in the previous figure. But the overall conclusion, which is significant to us, is that the difference between capital gains experienced by white households and black households remains large. Now, in addition to the effects of the policy shock on the value of assets held by a household, there are some additional effects we want to take a look at, which work through wealth. And these are the things that we call the capital income effects. In particular, as a accommodative monetary policy shock reduces interest rates, mortgage rates could come down, and deposit rates on savings would come down as well. Well, the decline in deposit rates on savings and the decline in bond interest rates represent a loss of income to the household, while at the same time, the decline in mortgage interest rates represents the ability to refinance mortgages at a lower rate, which is equivalent to a gain or a benefit to the household. We assume that the monetary policy shock passes through to deposit rates. We use the effect of the monetary policy shock on treasury rates to infer the impact on mortgage rates, and assume that every household refinances when interest rates change. With those assumptions, we calculate the effects on what I call capital income after 1 year, and you have the gains for white households from mortgage refinancing exceeding the gains for black households, and the losses to white households from the decline in deposit interest rates exceeds the losses to black households. Now, turn now to the earnings effect and the comparisons that we want to make. As I noted earlier, the policy shock does not have any effect on the wage gap between average black and average white earnings, but it does have an effect on the unemployment rate gap. And so we will look at the implications of the effect on the unemployment rate gap for earnings generally. We do that by looking at the difference between the average labor income of black household heads who were employed during the year and the average labor income of black household heads who experienced unemployment during the year. Unemployment is often temporary, often for a short period of time. Just because you experience unemployment doesn't mean you have zero earnings during the year, but clearly you have less earnings than the typical household had who did not experience unemployment. That difference is, as we see, about $28,000. The effect of the policy shock on the unemployment rate is not large. Its peak is at about 24 months. And when we combine those, we find that the relative gain in earnings after 24 months for Black households relative to the average Black household compared to the average white household is all of $39 or less than 0.1% of average household income. Now, of course, those earnings effects will compound or accumulate over time. So what we show in this figure is the small numbers down below are the relative earnings gains for Black households as they accumulate over a 5-year period as a fraction of Black household income. And the comparator is the relative gain, capital gains for white households relative to Black households as a fraction of average white household income. Now, clearly what this shows is that the capital gains, at least in numerical terms, are much larger than the earnings gains, but that's really an apples and oranges comparison, which requires a little bit more investigation. In order to make that comparison a little bit fairer or appropriate or less apples to oranges, if you will, we will look at the effect of the wealth changes of the capital gains onto consumption. After 5 years, the capital gains of the average white household are about $16,000 larger than the capital gains of the average Black household. Typically, taking a typical estimate of the marginal propensity to consume out of wealth of 0.03, that would imply an increase in consumption of $470. And so the increase in consumption from capital gains of white households relative to Black households is about 3.5 times larger than the cumulated relative earnings gain over a 5-year period. Now, traditionally, economists often argue that monetary policy shocks seem to have short-run effects only. We argue that in addition to the empirical observation that these asset price effects of a monetary policy shock can seem to be rather long-lasting, there are lots of good reasons why why policy shocks might have long-lasting or even permanent effects, even if those capital gains are unrealized. For example, they may lead to a relaxation of collateral constraints, which make it easier for households experiencing these capital gains to obtain credit, which could have permanent implications. Bequests or accumulation of unrealized capital gains could change behavior with respect to entrepreneurship, with respect to patterns of asset holding, all of which could have permanent effects. So these monetary policy shock differences with regard to race can have permanent effects on economic behavior in each group. In conclusion, Black households reap larger benefits from accommodative policy in terms of employment and earnings. White households have larger capital gains on assets. Although those two things are difficult to compare, we feel that by any measure, earnings gains are small relative to the portfolio effects. Policies that reduce the earnings gap exacerbate wealth inequality. That creates a challenge because reduction of racial inequalities is a major policy objective shared, I think, by everybody. But the conventional tools of monetary policy may not be the right ones to achieve it. And when somebody like Raphael Bostic, president of the Atlanta Fed, suggests that the Fed can play an important role in helping to reduce racial inequities and bring about a more inclusive economy, I think it's fair to wonder, how can it do so? Is it possible for a central bank to pursue these objectives without getting embroiled in politics and compromising its independence? The goals are laudatory, the challenges are enormous. Thank you.
Thanks very much, Paul. The first discussant is Sandy Darity.
Good afternoon, everybody. I'd like to begin by saying that I think that there's a very clever partition in this paper that's made between the employment effects, which ultimately become income effects, and the wealth effects, which ultimately are associated with portfolio variations, as well as what the authors refer to as a capital income effect. That these two effects are nicely described and discussed in this paper. There are some measurement issues that I'd like to raise at the beginning of my comments. The first of these concerns the way in which the wealth gap is measured. I think it should be assessed exclusively on the basis of the mean differential in Black and white wealth rather than the median. It's customary for folks to say we should focus on the median because that's more representative of the typical experience of most households. However, there's a couple of considerations that lead me to take the position that it's the mean that should be the object of attention. The first of these is 97% of the wealth held by households in the United States is held by those households with a net worth above the median. And related to this is the point that this kind of skewness in the distribution of wealth is not exclusively due to the presence of a handful of extraordinarily rich white billionaires, although there is a handful of extraordinarily rich white billionaires. But it's noteworthy that 25% of white households in the United States, it's 1/4 of them, have a net worth in excess of $1 million. And that's true for only 4% of Black households. If we were to focus exclusively on the mean differential, I think the effects of Fed policies on the Black-white wealth ratio necessarily will not appear to be as dramatic as they appear with the focus on the median ratio. The second measurement issue that I'd like to raise concerns the question of the utility of focusing on inequality as an indicator of well-being. So let's take, for example, the unemployment rate ratio. And I would argue that the racial ratio of unemployment rates is a powerful index of the degree of discrimination in the United States economy, but it's not a sufficient index of deprivation or relative deprivation. Historically, the ratio of Black to white unemployment rates in the United States has been fairly consistently in the vicinity of 2 to 1. This is virtually a stylized fact of unemployment rate differentials by race in the United States. Now, there are some rare exceptions. For example, in the month April 2020, the second major month of the onset of the effects of the pandemic, the Black-white ratio almost converged. The Black unemployment rate was in the vicinity of 16.7%, and and the white unemployment rate was in the vicinity of 14.2%. Now, after that month, there was a subsequent reversion to the norm of the 2-to-1 ratio. Today, the ratio is exactly 2-to-1. As of February 2022, the Black unemployment rate was 6.6% and the white unemployment rate was 3.3%. But I would argue that conditions were considerably worse for Black Americans in April 2020 versus February 2022 due to the much higher overall unemployment rates independent of the degree of inequality. So inequality is greater today in terms of unemployment rates, but the degree of problems that folks are confronted with are probably not as severe as they were in the immediate onset of the pandemic. There are similar issues that are associated with calculating wealth ratios. Black wealth is so low that changes in the ratio may substantively leave conditions fairly unchanged. Now, in addition, I do have some concerns about the simulation exercise, although I think that their conclusion seems fairly plausible, that there would be more substantial effects on wealth than there would be on income as a consequence of accommodative monetary policy. But accommodative monetary policy is interestingly enough the illustration that the authors choose to use instead of examining the effects of a tight monetary policy. And I would argue that the potential impacts are not symmetrical. But there's no simulation exercise that they perform for a non-accommodative monetary policy. The illustration in their simulation exercise also constitutes an exercise in looking at Fed policy that is highly incremental, lowering the interest rate by effectively 1 percentage point. The distributional effects that might be of greatest concern to us are probably associated with non-incremental changes in Fed policy. So let's consider the Volcker era tight monetary policy, where the federal funds rate rose from 11.2% to 20%. And in the process, the Federal Reserve induced a recession. The overall unemployment rate in the United States economy went in excess of 10%. And in the period 1982 to 1983, the Black unemployment rate was in excess of 20%, while the white rate was just approximately 10%. So there were huge effects on employment and income associated with the Fed's policies. But these policies were not incremental. It was not a small change in interest rates that took place. And I think we need to be able to examine what the implications are when the Fed takes policy steps like that. Moreover, the effects of Fed policies are contingent on initial conditions. The conditional backdrop is something that has to be taken into account. For instance, suppose you have the Japanese situation with low growth and low interest rates, effectively negative real interest rates. Then it's impossible to drop the nominal rates by 100 basis points under those circumstances. And the impact of monetary policy on overall distribution or intergroup distribution is unlikely to be of any significance because conventional central bank interest rates management policies are empty of impact in those circumstances. And you certainly wouldn't want to be raising interest rates in a situation in which you have a fairly stagnant economy. So this paper simulates a 100 basis points fall in interest rates under a Romer shock, presumably an unanticipated change in Fed policy. Now, why do they choose to use a shock in this analysis? Is it because they are assuming that an anticipated change in central bank practices will have no real effects? I think that the key to the absence of real effects is not expectations around federal policy, but it's the character of the initial conditions under which the policy is introduced. And I think it would be important in future work of this type to vary the initial conditions. Final point that I'd like to make is the following. The Fed's impact on racial inequality raises greater concerns about tight monetary policy rather than accommodative monetary policy. And the Fed is motivated to pursue tight monetary policy when high inflation is imminent or is currently being experienced, just as we are in the present moment. But the aggressive use of the Fed's traditional instruments for fighting inflation can produce a recession. The Volcker recession was pronounced with deep harmful effects for all Americans, but disproportionately so for Black Americans. And this is one of the reasons I'm an advocate of a federal job guarantee, an assurance of a public option for employment for all Americans at non-poverty wages with a benefits package similar to all federal civil servants. De facto, a federal job guarantee would make the Phillips curve vertical at a zero unemployment rate. No one would be looking for work who could not find it. And the Fed could then tackle inflation without fear of extreme adverse social consequences. Otherwise, in an environment in which we do not have that type of cushion in place, beware non-accommodative monetary policy. Inflation can have disproportionate adverse effects by race, but anti-inflation measures can have a disproportionate adverse effect by race, and I'm not sure which one is necessarily worse.
Thanks, that's really interesting. Ben Moll is the next discussant.
All right. Thank you very much for letting me discuss this paper. So here's my view. I think it's a super interesting paper on a very important topic, obviously. So the key finding, as Paul already explained very nicely, is that expansionary monetary policy has opposite effects on racial income and wealth inequality. So on the one hand, when interest rates are cut, the racial unemployment gap declines, and therefore racial earnings inequality also declines. On the other hand, when interest rates fall, asset prices increase, then white people have more of these kind of assets whose prices increase, and therefore the racial wealth gap increases. Therefore, the conclusion is that monetary policy faces a trade-off, so monetary accommodation widens racial wealth inequality as it reduces income inequality. There's a somewhat more provocative version of this conclusion also in the paper, which is that the effect, the reduction in the earnings gap pales in comparison to the effect on the wealth gap. There's a very nice and striking graph in the paper that makes this point powerfully. So there's in light blue, there's the relative earnings gains for Black households, and in gray, there's the relative capital gains for white households. And the whole point of the graph is basically that these light blue bars here, they're so small that you basically can't even see them relative to the gray bars. So they pale there. And therefore, then the conclusion is our analysis therefore does not bode well for the suggestion that more accommodative monetary policy helps alleviate racial inequality. So basically, accommodative monetary policy is bad for racial inequality. How does this work? So what's going on there? I would say it's important to point out that the key here is that monetary policy in their estimates has these large and very persistent asset price effects. Okay, so here's one of their graphs, and that's the 100 basis point monetary policy shock, so the Romer thing. And look at the graph up here on the upper left-hand side. That's the stock price effect. You can see the effects are large, so you get sort of a 3 percentage point or something like this larger stock price growth. But then the key thing really to look at is here, the x-axis has months on the x-axis. So 60 months here is 5 years. You get these super persistent effects on stock prices over where stock price growth is higher over the next 5 years. So I found it kind of surprising, to be honest. There's a very nice and helpful discussion in the paper. And as they helpfully point out, this sort of is consistent with some other estimates in the literature. But to me, it's still sort of a bit puzzling what's going on there. Anyways, it's there in the data, apparently, so it is what it is. But it's kind of important to keep in mind where these results come from. Okay, so here's the plan for my discussion. So essentially, I'm first going to just have a little quibble with one of the ways, the exercise they're doing. And then I'm going to have sort of one main comment on their more provocative conclusions, so these light blue bars versus these gray bars. And Paul already touched upon this a little bit, and I want to say that there's a little bit of an apples versus oranges comparison problem. Okay, so my little quibble here is that, so, you know, they want to compare these effects on the, these earnings and portfolio effects. And you know, they realize it's not quite straightforward. And so then what they do, or one of the exercises they do, is they convert the capital gains, so these portfolio effects, into consumption units. Now, in their data, they do not observe consumption. It's the Survey of Consumer Finances. So what do they do? Well, they use existing estimates for an MPC out of stock market wealth. In particular, there's a very nice Gabe Chodorow-Reich and co paper that has an estimate here of 3.2 percentage points. But this literature obviously sort of provides an average number rather than an MPC by race or other observables. So as a result, they're sort of forced to use the same MPC for Black and white households. So my quibble here is then simply that I think it's quite possible that the MPC out of stock market wealth for Black households could be substantially larger than for white households. Why? I mean, a number of reasons. A, Black households may have lower liquid wealth, maybe collateral effects are more important, and so on. So just to, you know, give you an example, this is going to be a bit of an extreme example, but just to make the point. So imagine that white households have MPCs of 3 percentage points like they have in their estimates, but that instead Black households have MPCs out of stock market wealth of 20 percentage points. So that's a bit of a high number, but just to make the point, then if you do the exercise they do, which is just to basically take these wealth gains, okay, and then multiply them up with the MPCs, then you get these numbers here, and you immediately get that the Black consumption gain would be actually larger than the white consumption gain. And if that were the case, you know, the conclusion would be really that the main finding of the paper would be reversed. In particular, monetary policy would then reduce racial inequality in sort of both these dimensions that they talk about. Okay, so now I wanted to turn to my main comment, which is really a comment on this provocative conclusion that sort of in the end, expansionary monetary policy is bad for racial inequality. And in particular, I want to come back to these light blue and gray bars and sort of talk a little bit about how can you compare them. And there's this a bit of an apples versus oranges problem. Again, one is sort of the relative earnings gains, and the other one is the capital gains. Okay, so again, the paper compares these earning gains with capital gains. On the face of it, that's a reasonable thing to do. I guess both are in US dollars, so why not compare them? But what's important to realize is that these capital gains are obviously unrealized capital gains. And so there's a sort of important question, which is are unrealized capital gains, in particular those generated by a decline in interest rates, comparable to earnings in some way, as they would be maybe under a Hayek-Simons income definition where you include unrealized capital gains in income. I looked around in the literature a bit. There's actually a very nice discussion of this in Kaldor's 1955 classic, An Expenditure Tax. He has this nice passage here. I just wanted to read this to you. So he says, we may now turn to the other type of capital appreciation, which reflects a fall in interest rates. So exactly what we're talking about, rather than the expectation of higher earning power. This is in a sense an intermediate category, so relative to some other stuff he discussed, since the rise in capital values in this case comes without a corresponding increase in the flow of real income accruing from that wealth. Okay, and then he says, for insofar as a capital gain is realized and spent, the benefit derived from the gain is equivalent to that of any other casual profit. If, however, if it is not realized, there's clearly only a smaller benefit. So the point is, the capital gains are only income when you realize them, essentially. And this is particularly so for these capital gains driven by falling interest rates. Then Calder's takeaway from this discussion, he has a lot more arguments as well, is essentially it's super tricky to define a notion of income that would be a good tax base. And then he says, therefore, he sort of prefers an expenditure tax rather than an income tax. And that's the title of the book, essentially. Okay. There's actually a literature here in particular macro and household finance that talks about related things, in particular things about the effect of asset price changes on wealth and maybe welfare inequality. Here's a bunch of references going back to 1940. I highly recommend this very nice Wally 1979 paper. It's sort of a 3-page paper, capital gains taxation and interest rate changes. And he makes some nice similar points with a graphical analysis. But I also wanted to tell you about sort of one project briefly that we've been working on, which is, I think, very related and is sort of a good way to thinking about exactly this issue here. So this is a paper here called Asset Price Redistribution that we just finished the first draft of yesterday, actually, to submit to the NBR Summer Institute, I guess. Has a lot of co-authors here. So I just wanted to kind of give you a very a flavor of this because it's really exactly relevant to the discussion here. Okay, so the question we're concerned with is essentially the following here, which is essentially, is there a way to convert the oranges into apples? Okay, is there a way to translate asset price changes due to falling interest rates into sort of a money metric welfare measure that is comparable in some way to income gains? Okay, and what the answer we give is yes, there is, and you can actually come up with sort of a nice, simple, sort of sufficient statistics formula for something like an equivalent variation of asset price changes. Okay, so the idea is what's if you say asset prices are going up because monetary policy cuts interest rates. So the question is, what's the equivalent amount of money I'd have to give you to make you as happy as you are from experiencing this increase in asset prices? Okay, and the simple formula we have here is this one here. So the welfare gain, or this equivalent variation, again, this is in dollar terms, kind of looks like this here. So it's a present discounted value just because people are forward looking and prices change over time. And then it has two main components here. Okay, the first one is what happens to asset prices. So how much asset prices change. In particular, what you want to look at here is something like a percentage change in the price dividend ratio of the assets, which is exactly what happens when interest rates fall, right? The price dividend ratio increases, essentially. But then the other thing that's important is what's in there is net sales of the assets, where net sales, if they're positive, you're selling, or if they're negative, you're purchasing the asset. Okay, and the lesson that comes out of this formula here, where I should have said this is essentially an application of the envelope theorem. The lesson that comes out of this is that rising asset prices, they don't benefit necessarily the people who have large asset positions, sort of the stock. Instead, they benefit sellers. Okay, or put differently, for people who never sell their assets, when asset prices go up, really, this is just a paper game. Okay. In contrast, for people who are prospective sellers, say you have a house and you want to downsize your house because you're retiring, and then the house prices go up, that would be a positive equivalent variation. On the converse, if you don't have a house yet, say like me, and you're thinking about buying one, and then house prices in London go up, then that's bad for you. That's a negative welfare gain. Okay, so that's kind of the logic of the formula. And then what we do in this paper is essentially we implement this formula with this nice Norwegian data, where in particular we have admin data on asset transactions. So the key here is the transactions matter rather than the stocks, the positions of the assets. Okay, here's the type of things you get there. Okay, this is a histogram of these equivalent variations or welfare gains and losses in Norway, you get a lot of heterogeneity, okay? Some people win sort of the equivalent of $150,000. Some people lose $150,000. You can see what's kind of interesting is there's a lot of dispersion, but the average is kind of centered around zero. So it's very close to zero. Why is that? Well, that's just because essentially for every person that buys, there's someone else who sells. And so, right, because there's the sales in there. And so then as a result, more or less for everyone, for every winner, there's a loser. So these asset prices are purely redistributive that come out of interest rate changes. And that's also the title of our paper, Asset Price Redistribution. But that's not my main point. The main point I really wanted to make is to compare that to another exercise you could do, which is to just, instead of looking at this equivalent variation, just look at changes in wealth, which is essentially what the authors do in their paper, okay? So basically just compute the changes in wealth generated by the interest rate cut, okay? And what you get there is basically this gray histogram here, and you can see it looks very different from the sort of equivalent variation from the welfare relevant changes, okay? And there's two main things. The first one is these welfare changes are much further sort of to the left, so are lower than these wealth gains. Again, that's because it's really about the sales and purchases, and so you know it's got an average to zero, whereas here this has a very positive average here. And then the other thing is they're correlated, but the correlation is very far from one. Okay, so they're correlated. Why? Because selling in a sense requires having in the first place. So that there's a positive correlation, but the correlation here is say 30% in our data. Why is that? Well, just because there's a fair amount of people who have large asset positions who buy even more assets when the asset price goes up, so they lose. Conversely, there's a lot of people who have low asset positions who actually sell, so they win even though they have low asset positions. Okay, so why am I telling you all of this, or what's the implication of this for the paper under consideration? The main point is here just, well, you want to be a bit careful when you compare earnings gains and unrealized capital gains. And I think really to do this in a satisfactory fashion, you kind of need either consumption data or transactions data like we do in Norway. The paper doesn't unfortunately have either, and that's just a data constraint in the US, I guess. So I'm a little nervous about this provocative conclusion here that accommodative monetary policy hurts overall racial inequality, so that you can sort of net out these light blue and gray bars. But at the same time, I think it's important to say the following conclusion still stands. So monetary policy makers do face this trade-off here between where accommodation widens racial wealth inequality, but it reduces income inequality. And to me, that's sort of super interesting and important finding to begin with. Okay, so let me wrap up. In summary, really, really great paper. Comments and questions again. So the first one was just that the assumption that Black and white households have the same MPCs out of stock market wealth could bias these results. The second one was this direct comparison of earnings gains and unrealized capital gains faces this sort of a bit of an apples and oranges problem. Really, to convert the oranges into apples, you need either consumption or transactions data. And so they don't have that as a result. To me, it's a little unclear whether this really provocative result here survives, but at the same time, this point about the trade-off is really interesting and important. Okay, I'll stop here.
Okay, thanks very much. There's a great set of discussion comments from both the discussants. So we have a number of questions. I'm going to start going down in the order in which they're there. I'm going to start with Justin Wolfers.
Great. Look, this is a really wonderful paper and a wonderful analysis. And so my question is really just about interpretation. The identification comes from the Roma and Roma shocks. And so one way of thinking about this is that, in the search for clean econometric identification, we're looking at those times when the Fed deviates from its usual policy rule. So it's, the entire paper is focused on when it ignores the Taylor rule. That means the paper tells us a lot about what happens when the Fed does something unusual. It also means it tells us nothing at all about the implications of what happens when the Fed does the usual boring stuff of following the Taylor rule. And so I think, Roman Roman tells us a small amount of what the Fed does. And so the harder question really is about what normal systematic monetary policy does to racial gaps. That we're focusing on the shocks. Well, we know that shocks that are unexpected move financial markets a lot. And so we would expect the unsystematic part of monetary policy to have the bigger effects, to have large effects on wealth. But the systematic parts, which are expected, we'd expect to have no wealth effects whatsoever. If you think about the income side of things, you might think that it was going to be more parallel either way, that, the usual way we think monetary policy works is going to have as much of an effect on black-white unemployment gaps, whether it's anticipated or not. And so you might get very different implications for what regular Fed monetary policy does for black-white gaps, as opposed to analyzing only the shocks.
Thanks very much, Henry Aaron.
Yes, I tuned in a bit late on the initial presentation, so I hope I'm not covering a point that was dealt with in the initial presentation. But my question is 5 years long enough? The reason I ask the question is that in a sort of simplistic way, one would expect a drop in interest rates to increase the value of assets for a given flow of income, given the change in discounting out the future, which would be realized relatively quickly. If one changes the underlying labor market conditions, one would expect to see some initial effect on employment, perhaps especially at the bottom end of the income distribution. But perhaps more importantly, over time, one would expect to see a change in the dynamics of labor markets with opportunities for promotion, investment in human capital, either by workers themselves or expenditures on training by employers, so that over time, one would expect in this naive framework to see a continuing effect on earnings, but after an initial period, little or no additional effect on asset values. So back to my initial question, is 5 years long enough?
Rick Mishkin.
Okay, hopefully you can hear me. So there's really an important policy issue, and Paul raises it at the end of his talk, which is, should the Fed take account of its effects on racial inequality from the policies that it's actually conducting? And I would argue that the answer is really very much no. And it's not saying that this research isn't very important, because you do want to think about other policies that might have to deal with the implications of a Fed action, which could be actually harmful to some part of society. So this is not just about racial inequality. We know that monetary policy has big distributional effects. So it's also going to affect income inequality. It can also have very big distributional effects in terms of parts of the economy that actually are hurt by either tightening or loosening monetary policy. So the big problem here is the Fed basically has one instrument and already has a problem that has two key objectives, which is unemployment and inflation, and that's hard enough for them. And the second issue is that these issues of inequality, and I think also racial inequality, income inequality, huge important issues that we have to deal with, climate change, we can list quite a few, are ones that actually are very political. And there really is a very strong reason for trying to make the Federal Reserve as less political than other parts of our policymaking enterprises. So I would argue that, that this research actually is important, because it tells us that if there are effects in terms of inequality or wherever else in terms of distributions, you might want to think about how you might want to counteract them or get better outcomes from monetary policy through other policies. But that's really something that the government needs to do, not the Federal Reserve. And the Federal Reserve has gotten much more political, particularly after the COVID crisis, where it actually entered monetary policy actions, which affected actually with lending to small businesses, buying corporate debt and state and local government, that really has the potential to politicize the Fed in a very dangerous way. So I think that there's a caution here of how this research should be used. There's a danger that the research can be used in the wrong way. And I think that we have to be just very careful about that.
Betsy Stevenson.
Yeah, thank you. So some of my question was actually asked by Hank, but let me just expand a little bit, which is to say when I'm thinking about, the value of your wealth going up, I think we do want to think about it beyond just what people might be consuming today, because high stocks of wealth let you secure things like lower interest rates, and provide a lot of opportunities in the future. But I do think when we're thinking about the labor market, I do think you have to think long term about how avoiding a spell of unemployment or a long period of unemployment has payoffs that last a very long time. So I just that elaborates a little bit on what Hank said. I actually wanted to take then what Rick Mishkin said is, should the Fed be thinking about this issue, and just actually turn it in a little bit of a different way, which is, I've always thought when we think about the Fed running very accommodative policy, it's running a risk of high inflation, and that high inflation hurts savers and benefits people with a lot of debt. But I think if you look at the findings in this paper, it raises a question of, the Fed, we look at right now, did the Fed run too accommodative monetary policy that might be hurting the savers like baby boomers who are trying to live off their savings, but at the same time, that accommodative monetary policy is what allowed them to accumulate a lot of wealth. And so should we be thinking about that offsetting effect when we think about risks around monetary policy, when we're risking inflation in order to ensure we've brought everybody back to work?
Thanks. Don Cohn?
Thanks. So I had some thoughts that were similar to both Rick and Betsy, I guess. I thought this was a really interesting paper, and only in part because it confirmed my intuition that easy monetary policy reduces income inequality while it raises wealth inequality. But I also completely agreed with the conclusion that monetary policy was not the appropriate tool to address income or wealth inequality gaps. And I wondered whether there was any conclusion that any finding in the paper, whether the authors think that there was any finding they could get in the paper that would get them to agree with Joe Biden. So to add to maximum employment, stable prices, moderate long-term interest rates, racial income or wealth gaps. So in my mind, I don't think so. I mean, I think the trade-off, so not easing policy in order, suppose you'd found that easing policy increased income gaps. I still would say easing policy lowers unemployment. And why would I deprive both Black and white households of employment just because gaps between the two would increase? So I don't, I couldn't in my mind construct a finding that would get me to add gaps to the maximum employment stable prices thing. And in that regard, I never quite understood what the broad-based and inclusive employment goal was relative to the employment goal that was consistent with stable prices. So if it's different from that, then I don't think there's a stable trade-off between gaps, the racial equity gaps, and the employment and inflation objectives there. I don't see how you could ever do it. Thank you.
Brad Hirschman.
Oh, sorry, I withdraw my question.
Oh, okay. Stefania Albanese?
Yes.
Yep, go ahead.
So we sort of know from evidence, mainly cross-country evidence, that relatively high inflation redistributes against low-income households in a couple of ways. One through balance sheets, and the other is that usually inflation is higher for households at the low end of the income distribution. And so inflation hasn't, sort of come up at all in this paper, which I very much like. And I was wondering whether that was because here we're looking at monetary policy shocks, and we know that at least in the United States, monetary policy shocks do not have much impact on inflation, particularly in the couple of years right after the shocks. And instead, if we think about, low inflation monetary policy, such as the Fed has been conducting in the last, 30 years versus a higher inflationary environment, whether there we would see, a redistributional impact along racial lines of inflation as well. And in that sense, how can we think about the results here versus, the impact of inflation, and if the authors have any thoughts on this?
Okay, and we have a question in the Q&A from Ben Bernanke. A naive listener might conclude from your paper that in the interest of racial equity, the Fed should never ease monetary policy, even in a deep recession. Is that a correct inference from your paper? And if not, why not? That seems like a good note. Since we have no more, do we have more questions? I'm sorry, we do have George Perry, sorry. George? Okay. George, we're not getting you audibly. You could drop something in Q&A and I'll read it. Justin Wolfers, all right, one more bite at the apple, but you've got to be quick here.
Again, to be quick, I just wanted to return to Rick Mishkin's claim that the Fed shouldn't be responsive to racial gaps. That's a claim that's made at a moment where the Fed already describes and expresses concern about the effects of its policy choices on savers and on borrowers. Wall Street definitely speaks up, and Wall Street gets listened to. So the idea the Fed that can be responsive to all of those groups, but should just look the other way when it comes to racial disparities seems pretty hard to rationalize or explain or justify. It's one of those moments where I realize that we are in a conference that has no Marxist economists, but if there were one in the room, I suspect it's a moment where they would be speaking up.
Just to add, though, I would say that the Fed should not be responsive either to the special interest that you just mentioned. It has a basic objective, which is a public policy objective of dealing with inflation and unemployment, and in fact needs its independence to do that properly, and that should be what it does. It needs to stick to its last.
I'm pretty sure a close reading of the accumulated speeches of then Governor Mishkin would suggest a real concern with the effects of policy on, say, the returns to capital.
I think there's plenty for the panel to weigh in on. So I'm going to turn this back to the authors for a few comments, but I'd love to actually make sure we have time for Sandy and Ben to weigh in too. So authors?
Well, I could try to take the easy questions and leave the difficult ones then for Paul and Alina and the other Moritz. First of all, thanks so much, Sandy and Ben, for the great discussion. And I'll just wanted to, that's extremely helpful. I think you raised the points that we really need to think about. I wanted to push back on a couple of points quickly. The one is on the MPC. I think you need to make pretty extreme assumptions to reverse our results. I think it's homework for us to get better empirical ideas there. What do we know about differences in MPCs, and is any of this realistic, like a 6 times higher MPC for black households than for white households? But it's a good point. The more general point, and I think there's also part answer to Ben Bernanke's question in the chat is, I mean, I'm not 100% sure that these paper gains are so inconsequential as you think of them. So one is, in a world with borrowing constraints, these have effects on collateral constraints, and these collateral constraints in turn might have permanent effects on wealth inequality. If you think about opportunities to set up a business, if you think about opportunities to send your kids to college or go to college yourself, or invest in your human capital. So although they're just paper gains, so to say, and we don't realize, or they're not realized, they might still have real effects. And connected to that, and that's the question that was raised earlier, is if we think about the realized capital gains, I think you can connect this to systematic distributional consequences, and this connects to Ben Bernanke's question about the recession, and should monetary policy never intervene, because we have this effect in or this trade-off. I think if you look, there's an interesting Dirk Kruger et al. Paper about the distributional effects it talks about the Great Recession, making the point that younger households would systematically prefer asset prices to drop more than wages, because that helps them in terms of welfare. And I think you can, coming back to our setting here about racial disparities, I think you can make that systematic argument about some groups in society profiting, some losing out, about the racial side as well. For example, if you have inherited differences in home ownership because of past discrimination, you have sellers and buyers being very distinct groups in society, because you didn't have the same opportunity to own a home, or because you're old and young. But I think these systematic differences may matter and are worth thinking about. In the end, I think I absolutely agree with Ben's bottom line. There are trade-offs, and I think we haven't thought about these trade-offs quite enough. I'll leave it here, and again, the difficult questions for my co-authors. Thanks so much.
One or two very quick responses, because I do want to make sure we have Sandy and Ben too. So the authors have one or two quick words.
I'll just add a.
Oh, you're on mute. You're on mute. There we go.
Okay. I'll add just a very, very brief comment, which is I don't agree, and I don't think my co-authors agree with Joe Biden's campaign rhetoric. Making a racial inequality another goal of monetary policy would be a mistake. But at the very same time, as the discussion between Rick and Justin pointed out, the Fed has to be and is always mindful of what else is going on, and has got to be mindful of what the implications of what it might be doing are for other things. Everybody would accept that if we were talking about financial stability, but I think that those other things should include things like racial inequality as well. And so the implications of monetary policy over time for other things have got to be part of the Fed's decision process. And in response to Ben Bernanke, that doesn't mean being mindful of these things doesn't mean that an accommodative monetary policy is appropriate in many situations. We wouldn't want to rule it out altogether. But I think the implication of all this discussion is that monetary policy is a much more complex thing than economists like to think 30 years ago.
Okay, thanks. Sandy?
So first, I guess I'd like to make a comment about some of the rhetoric that's used, and it's not unique to this conversation. But this notion that the Fed should be independent of politics, maybe what people really mean is the Fed should be independent of partisanship. But there's no question that any step or decision that the Fed takes is political in terms of its impact, and so it's virtually impossible for the Fed to be independent of politics. Perhaps it could be independent of partisanship. And I would also like to add that the question of what factors are taken into consideration always comes into play with the types of decisions that the Fed is going to make. And so if we're saying that there's an additional consideration that has to be on the table, I don't see any fundamental problem with that. It's not any different from asking, in some sense, what the global effects are of a Fed policy with respect to unemployment and in terms of its distributional effects across the general population, as opposed to particular segments of the population that may merit special attention. That said, my final remark was entirely consistent with the position that certain types of social issues really cannot be addressed effectively through Fed policy. And that's why I was saying that the question of the provision of a guarantee of employment is something that should be conducted through a federal policy of that sort. And we can make the same kind of argument about racial wealth inequality in the United States. That's not something that can be addressed effectively through Fed policy. And for those of you who are familiar with my standard line on this issue, the argument that I make is that the only way in which you can truly address the racial wealth gap in the United States is through a comprehensive program of reparations for Black Americans.
Thanks, Ben. Very quick, if you have a final comment.
Yeah, I really just wanted to conclude with a sort of a plea for better data. Maybe there's someone here who can do something, maybe someone at the Federal Reserve. I mean, essentially, it seems what you need to do all these things well, and this comes up in lots of different contexts, is a data set where you have three things: income, wealth, and consumption expenditures, sort of essentially the SEF, but plus a good consumption measure. Or equivalently, you'd need income, wealth, and asset transactions, sort of panel data set. And neither of these exist in the United States. And to me, that seems kind of insane that basically you need to go to Norway or so to do these things properly, in quotation marks. So yeah, maybe someone can do something somehow. That'd be a big deal for lots of things, I think.
Okay, thanks very much. Thanks for a fantastic panel, great paper, really terrific comments from the discussion and from the floor. We will reconvene at 2:20.
Okay, we're ready to start again. We can have everyone gather. The next paper is ready. So Claudia is here. The author is Claudia Golden. She'll be presenting on understanding the economic impact of COVID-19 on women.
I am here and I'm just making this a bigger screen, I think. I can't make this a bigger screen, Jan. So, oh, wait, here it goes. Okay, now I can.
Looks good.
Okay, now it's going to be even better. Okay, is that okay?
Looks great.
Okay, thanks a lot. Okay, so the economic downturn that resulted from our COVID coma has had effects different from those of any recession in US history. This time really has been different. Never before have we needed to shut down the economy to get it running again. And never in peacetime have the caring sectors been as intertwined with the economic sectors. And never before has a recession impacted women more than men. The closing of schools and daycares, the reduction of home healthcare workers intensified the time demands on women. And even though work from home was safer, it was filled with interruptions, prompting some to cleverly dub it work from hell. It's no wonder that during the first year of the pandemic, news media and policy reports were jam-packed with alarming headlines and media echo chamber prophecies. My intention is to clarify the impact of the pandemic on women in 5 ways and answer the following questions. First of all, did we actually lose 33 years of female labor force growth, as the statement implies at the bottom? And also, what is the appropriate counterfactual or hypothetical to use to evaluate the impact of the pandemic on women, given the run-up in female labor force participation that I'll show that preceded it? Number two, should the pandemic be deemed a she-cession, as noted here and by many? Has gender been the greatest divide in this recession? And three, what was the increase in childcare time for working parents? And related to that, did the pandemic push mothers out of the labor force, as the headline states? Did 1 in 3 mothers actually drop out or scale back? And 5, since there are many factors that co-vary, what have been the separate effects of each? Occupation, race, ethnicity, education, and children on women's employment rates relative to men's. So let's dig in. The claim that the female labor force participation rate fell during the pandemic is not incorrect, but the implication that female labor force participation plummeted from a much higher level before the pandemic to one that was extremely low during the pandemic is highly mistaken. From April of 2019 to 2 years later in April of 2021, the decrease for women 25 to 54 years old was negative 0.4 percentage points. That for men was negative 1.4 percentage points, and I'm sorry, 0.7 percentage points for women negative, and for men negative 1.4. The female labor force participation rate in the US has been disturbingly stuck around 75% for some time. And one exception is the sharp run-up in participation that occurred just prior to the pandemic. Out of the 383 monthly figures since January 1990 to November of 2021, just 10 exceed that for January of 2020, and that's the red star. A substantial fraction of the women who entered in the period immediately preceding the pandemic left during it. And the increase was disproportionately among young, less educated women with young children. Its importance here concerns the counterfactual or the hypothetical in computing the impact of the pandemic. Differencing from January or February of 2020, as many have done, will produce larger shortfalls than differencing from a month in, say, 2019 or 2018. It will also attribute seasonal employment changes, particularly during the summer months, to the pandemic. The micro CPS data are generally not corrected for seasonality. So let's move on to number 2. Was the pandemic a she-cession? Women were, as we'll see, somewhat more impacted than were men, but differences by education were extremely large, still are, and less educated women and men were the most impacted. A simple way of answering the question is to use the monthly CPS to produce the fraction of the population, here 20 to 54 years old, by education and sex, who were at work, or the fraction in the labor force. At work here is employment, but excludes those who had jobs but were not at work, which has become a convention in the pandemic period. A difference for each of the 7 pandemic seasons shown here, from spring of 2020 to fall of 2021, from an identical season in a previous year. Although I chose to use the 2018 year, the results are not much different if I use 2019. There was a huge deficit initially, as you can see, 8 percentage points for the college graduates and 17 percentage points for the non-college graduates. And note as well that I provide the base numbers at the bottom so you can see the scale. The big differences pretty clearly are not necessarily by gender. The big differences here are by education. I'd like to make two more points before moving on. The first is that if I had instead difference from winter of 2020, which has been common in the literature and on which some of the statements I noted before were based, there would be greater decreases shown here as the additional faded bars. You can see it goes like this. Those are the additional faded bars for women, but generally not for men. And there is a greater increase in these faded bars during the summer months due to attributing the seasonal changes to the pandemic. The other point that I want to make is that the reason that the more educated were less impacted by the pandemic is that they could and they did work remotely. Even before vaccines were available, the more educated were effectively inoculated health-wise and job-wise. Ever since May of 2020, the monthly CPS has asked whether an individual has ever worked remotely in the past 4 weeks because of the pandemic. The fractions by sex and education given here clearly show that the more educated had a far greater ability to work remotely. Differences by gender are small relative to differences by education. In sum, differences in outwork and labor force changes, which I haven't shown, but which are in the paper, between men and women existed, but were not great. And there were and still are large differences between the more and the less educated. What about childcare time? By my calculations, childcare time in March of 2020 doubled almost overnight. The calculations I provide here are for different sex parents who are college graduates, both employed, with a youngest child less than 18 years of age. For parents with an elementary school-age child, see the red oval, hours for childcare alone increased overnight from around 15 per week. And the scale here is for hours of the mother, but the numbers on top of the bars are for the fraction that she did. So just divide and you'll get the total. So they increased overnight from around 15, with the mother doing around 58% before March of 2020. And they changed to around 33 a week, with the mother doing around 52% in April of 2020. Note that the fraction of the total that she did decreased, but her hours soared from just below 9 to above 17. Dads did a lot more at first, but in the fall of 2020, when work somewhat resumed and some offices, factories, and building sites opened up, but schools flickered on and off, mothers took up the slack, and their childcare hours increased to probably more than 22 a week, as did, and this is for childcare alone, as did their share of the total, which zoomed to around 70-something%, even as total childcare hours probably declined somewhat. Employed men focused more on their paid work, and employed women focused more on their childcare. My favorite photo from the New York Times series, The Primal Scream, says it all. By the way, she's on a work call. So what was the impact of children on women's outwork rates? To understand the impact of children on women's employment, I took the same differences by season for the fraction outwork as I did before among women with the youngest child of the varying ages shown here. The results show once again that education mattered a lot, and that among college graduates, those with a very young child actually increased their outwork rates across the pandemic. That's in the black oval. But that was not the case for the lower educated group. In addition, even women without children, of course, had deficits in employment relative to the previous year, and that's in the red oval. But even during the hardest hit months of the pandemic, the McKinsey lean-in claims that I showed before, that 1 in 3 mothers would leave the labor force, or 1 in 4 women would, was vastly off by a factor of somewhere between 4 and 25. So let me put it all together. To understand what matters most when gender, education, occupation, race, ethnicity, age, marital status, and the age of the youngest child are all considered, I constructed a sample of individuals here, 20 to 54 years old, who are observed in 1 CPS month at work or in the labor force, depending upon which one I do. Let's say at work here, and then another precisely a year later. So I have individuals who are observed in 1 CPS month at work, and then precisely a year later, we see what they did. They will traverse 3 pandemic phases. Some are observed only within the pre-pandemic period, from January 2018 to February of 2020. Some are observed entering the pandemic period after March of 2020, and some are observed within the pandemic from March of 2020 to November of 2021. The main effects of the regression are the pandemic phase, education, the child ages, race, and occupation, where occupation here is defined as a group of occupations, which I call service, that were impacted by state mandates that shut down businesses or limited their density. They include, for example, retail, restaurants, and various personal services. All variables are interacted with the pandemic phases. First here for women only, and in a moment, I'll show you the pooled regression for men and women. The results for at work for the pre to the pandemic phase for women are shown here. There was, as you can see, a 7 percentage point decline, which is the main effect. College cuts that more than in half. Children add to the decline, and being in one of the service occupations had disastrous consequences. Given all these factors, race mattered, and in the paper, I explore the health consequences of the pandemic as a likely reason. I next pool men and women, adding the interaction with female. The differential impact of women, the interaction of female, and the pre to pandemic phase shows the she session impact on at work rates, but also that the college graduate women completely make up for the deficit, and that there were no differences between men and women by occupation and race, even though there were differences by children relative to men with residential children. Almost no one has been untouched by the pandemic, but much of the deepest pain was experienced by parents, particularly women, whose caregiving increased almost overnight. And yet female labor force participation rates did not plummet, and at work rates greatly recovered for many, not all, from the initial pandemic shock. Women were stressed and frustrated, in large measure because they stayed in the labor force. They found new jobs. They persisted working in homes that were also schools and impromptu health clinics. A she session can be found, but not as much among the college educated. What about the future? Is it possible that we will emerge on the other side of darkness with benefits from our time in exile? Travel for business will be down, whoopee, and the cost of both temporal and geographic flexibility will decrease. But the new normal, that is still terra incognita. Thanks.
Thank you, Claudia. That was terrific. The first discussant is Stefania Albanese. Do you share your slides? You're working?
Why doesn't Jane go ahead? Because I'm having, 1 second. Okay, here we go. I think I have it. Okay, let's see. Oh, here we go. Sorry about that. Here we are. Never use a brand new computer for the first time in an official presentation. So thanks so much for inviting me to discuss this paper, which I think is really very helpful, particularly because, as Claudia suggested, it clarifies a bunch of statements that have been made over and over and over in the media. So let me start with this graph. So this is just the percent decline in employment by gender for the prime age population during the pandemic. So throughout 2020 and 2021, where the percentage decline is relative to the same month in 2019. And as you can see clearly here, at the height of the pandemic, the employment drop was about 4 percentage points larger for women than for men. And, you know, this was very novel because in standard recessions, as Claudia said, usually men lose more jobs than women. This is just a log variation of employment for men and women, again, prime age population, in the last 3 recessions before the pandemic recession. So starting with the 1991 recession. And you can see that in every single recession, men lose more jobs than women during the recession. So this is the entire recession plus 3 years after. And actually, so this phenomenon has been, you know, you can see it in earlier recessions as well, but it kind of became more of a well-known fact with the Great Recession, which The Economist, I think, was the first magazine to call it a man session because they realized that more men lost jobs than women in that particular recession. But historically in the United States, every recession prior to the COVID recession was a man session, if you want to use that language, which I don't particularly like. So what do we know about what happens in standard recessions to give us those kinds of facts about employment loss by gender? So there's a labor demand side and a labor supply side. On the labor demand side, it's kind of an easy explanation. So there's more men than women in the highly cyclical industries and occupations, manufacturing, construction, transportation, and so on. And then on the labor supply side, this is not a well-known fact to most macro people who think about business cycles a lot, but it is a better known fact to household economists and labor supply people and so on, which is the fact that particularly married women tend to increase their attachment to the labor force in recessions. And what you see actually is that women who would have exited the labor force had there been an expansion do not do so in a recession as a form of household insurance against the potential risk of job loss of their husband or cohabitating male partner. And so what we see in standard recession is both a labor demand force sort of leading women to lose fewer jobs and a labor supply force, which is coming mainly from the participation margin, and in particular, the employment to non-participation flow. Now, when, you know, then we go and think about what happened during the COVID-19 pandemic, it's useful to also, you know, put on the lens of labor demand versus labor supply. And so here I'm going to review some of the results that I have in a paper with Ji-Young King and so, relate them to Claudia's finding to give a broader perspective in terms of what she talks about in her paper. So as Claudia already said, on the labor demand side, you know, women are overrepresented in certain service occupations that were particularly exposed to the infection risk or the mandates, you know, that were put in place. But also on the labor supply side, you know, there was this idea that because of school closings and childcare closings and so on, you know, mothers were saddled with childcare responsibilities. And here I put a question mark at the end of that in the sense that, you know, this is, I think, somewhat of the dispute, you know, in Claudia's paper. So what she shows in her paper is that, yes, you know, mothers were at some level saddled with childcare responsibilities, but many didn't leave the workforce, particularly educated mothers who could work from home. So I want to give you a little bit more of a sense of these facts in the rest of my discussion. So first of all, I want to narrow in on, you know, which occupations were most affected by the pandemic and what was the gender exposure to the pandemic in terms of employment loss through this lens of the occupation occupational distribution. And so we came up with distinction between high and low contact occupations based on the distance with co-workers and customers that typical workers, have to take in their jobs. And then flexible versus inflexible occupations, this dichotomy is based on whether the occupation or the job, can be done remotely versus not. And so, with this distinction, we can come up with 4 occupational categories: flexible high contact, flexible low contact, and then the most relevant occupations are the inflexible ones, which cannot be done remotely, of which some are high contact, and so they require a lot of interaction with customers or co-workers, and they are mainly healthcare, personal care, and hospitality occupations. And then inflexible low contact occupations, which are production, construction, transportation, and so on, which are inflexible, but are not so subject to infection risk. And also, these are mostly the occupations that are affected by standard recessions for the most part. And in the table below, you see the distribution of men and women, prior to the pandemic across these occupations. And the inflexible high contact occupations account for 26% of all female employment, only 9% of male employment. And instead, the inflexible low contact occupations, they are very male dominated. They account for 40% of male employment, 11% of female employment. And then the flexible occupations, the one that can be done remotely, they actually are the biggest chunk of the occupational distribution. There's about more than 50%, of all workers are in fact in a flexible occupation. So that's something to keep in mind. So if we look at the change in employment by gender in each of these 4 occupational categories, so this is the graph that you see here, and all the differences are from the same month in 2019 to take account of seasonality. And this is, a very striking graph, and it sort of matches what Claudia also found as well, that if we look at the flexible occupations, well, first of all, they have much, much smaller drops in employment, and there are not very big gender gaps in that change in employment. But when we go to the inflexible occupations on the high contact side, so all these service type healthcare occupations, we see that there's a really massive drop at the height of the pandemic, about 40%, and then the gender differences are relatively small. But then when we go to the inflexible low contact occupations, which are very male dominated, we see that also there's a very large drop in employment, but the drop in employment is much larger in those occupations for women than it is for men. Of course, there are fewer women in those occupations, but that is sort of notable. And so essentially we see that in this male dominated inflexible occupation, women lost way more jobs than men, but men and women lost a lot of jobs. And then in inflexible high contact occupations, both men and women lost a lot of jobs. And the occupation distribution accounts for about 1/3 of the gender differences in employment behavior over the course of the pandemic. Now, the next thing I want to talk about is sort of, okay, so that's the effect of occupation. It's coming from, a labor demand factor. So now let's control for occupation as well as age and education and see if there are any remaining disparities by gender. And so what I'm showing you is the change in the employment to unemployment flow, which is seen as sort of job loss as determined by a drop in labor demand, something that usually rises a lot in at the beginning of any recessions. And this is also by family status. So looking at whether workers are married or single and whether they have any residential children younger than 12 with them. And what you see that even once you condition on occupation, age, and education, there are still some sizable gender differences in this employment to unemployment flow, and particularly at the height of the pandemic in March to May 2020, single women lost more jobs compared to single men, and the difference is with children, and the difference is very large. And you also see that for married women compared to married men. And there's also significant gender difference in the second part of 2020. But then when we get to 2021, we still see single women with children compared to single men with children sort of being more exposed to employment loss, so employment to unemployment flows. Okay, now let's focus on labor supply. So, this is where I think Claudia does really important work, sort of focusing us on the relevance of thinking about the counterfactual, because we have this weird phenomenon where at the end of 2019, there was a mini surge in participation of actually both men and women. So what you see, this is just the labor force participation rate for prime age people. as a percentage change to 24 months prior throughout 2019 to the end of 2021. And you can see that in 2019, towards the end of the year, there's this mini surge in participation, mainly for women, but to some degree also for men. They're much higher than they were, 2 years prior. And then you can actually see that the drop in participation overall is not that different for men and women, just looking at this raw data, which sort of confirms, what Claudia was saying before, that, with the counterfactual that looks further back relative to the start of the pandemic, you get less asymmetry across gender in the behavior of labor supply. Now, to get a better sense of what happened to particularly, people that might have left the labor force, what I do here is, again, controlling for age, education, and occupation, look at the change in non-participation relative, again, to the average in 2019, again, by family status. So we can compare people with children, without children, married and unmarried. And so what you see here is that even controlling for occupation, age, and education, you do still see that single mothers compared to single fathers have much higher incidence of a rise in non-participation. And then we also see that married mothers in the second part of 2020 see a bigger rise in non-participation compared to married fathers. And then the next step to sort of understand this better is, where does this rise in non-participation come from? So here I'm showing you two flows into non-participation. The employment to non-participation flow on the left, which basically are quits, people who had a job and decided to quit it, maybe because they had children that they needed to take care of. And on the right, the unemployment to non-participation flow, which is people who became unemployed and then decided to stop looking for a job. And you can see that there are no gender differences in the employment to non-participation flow, whereas all the gender differences are in the unemployment to non-participation flow. So the story that I get, from these results is that actually it was the decline in labor demand that was to some degree responsible for the decline in labor supply. So consistent with what Claudia found, the women, the mothers who were able to keep their jobs, then, they kept them the job through the pandemic despite all the challenges, whereas, the mothers who were laid off, were the ones who potentially exited the labor force. Now, just to conclude, let me just, because I'm running out of time, talk a little bit more about, participation going forward and put this more in a historical perspective. As Claudia pointed out, participation of women in the United States has been stagnated since the mid-90s. And though there's been a ton of work on the rise in participation, there has been very little work on understanding why women's participation hasn't continued to grow since the mid-90s, and there's still this very big gap between female and male participation for prime age people. And so I've done some work on this, and it turns out that in this longer run perspective, most of the discontinued rise in women's participation is coming from married women, and particularly married women who are married to college husbands or in general high-income husbands. So if we compare the trend in participation pre-95 to what we see post-1995, most of that flattening out is coming from these high-income women married to college husbands. And so the idea that I've pursued in my own work is actually that the rise in top earnings, particularly for men, is partly behind this. And this is also related to Claudia's greedy jobs, idea, which is, there's been sort of a negative wealth effect on wise participation in market hours coming from the rise in top earnings of men. And so because college women tend to be married to college husbands, college women actually have seen this slowdown in participation, despite the fact that they have accumulated, a lot of education and labor market experience. So in the broader context, the flattening of participation is coming mainly at the high end of the income and the education distribution, though during the pandemic, the loss in employment and the decline in participation is coming mainly from the low end of the wage and the income distribution. So let me just conclude here Just to say that, looking forward, I think if we want to sort of think about participation beyond the pandemic, we need to think about this historical change in the trend in female participation. And from a macro perspective, female participation has been really important in terms of sustaining TFP growth, wage growth for women and men, as well as, strong recoveries of the aggregate employment, over the business cycle. And so it's going to be important to not just focus on the pandemic, but on this broader trend, going forward. Thank you.
Great. Thank you, Stefania. That was great. The second discussant is Jane Olmsted-Rumsey.
Sorry, let me share now again, now that it's full screen. Okay.
That's good.
Great. Okay, so thanks so much for having me to discuss Claudia's excellent paper. First, to just summarize what this paper is, I would say it's a comprehensive review of women's labor market experiences during the pandemic. And sort of the biggest takeaway is that the paper revises the view that gender was kind of the most important cleavage in terms of labor market outcomes during the pandemic. Instead, she really points most importantly to the role of education, this discrepancy between college and non-college, but then also points out that, of course, occupation was an important cleavage as well, and that's related to Stefania's work. And then also points out that even on top of that, race can still explain some of the differences in labor market outcomes. And I think one important contribution of this paper relative to other papers I've seen is, many people are finding the statistical significance of race in terms of labor market outcomes. Claudia actually uses survey evidence to show that health may be a driver of this. So there are differences in reported health outcomes and also the propensity to be caring for someone who's sick during the pandemic by race, which could be one explanation for these racial differences. And I haven't really seen that coming out very strongly in other work. So I appreciate that as one big contribution. On the other hand, the final takeaway from the empirical part is that gender was in fact a strong predictor of the rise in caregiving time, and that women had a bigger increase than men in the amount of time that they spent on childcare and other caregiving responsibilities. And then in the final part of the paper, she gives a nice kind of forward-looking view of what the effects of this persistent work from home post-pandemic might be for women's participation, the types of jobs that women are able to take, and then also their pay and promotion as a result of this. So I have three main comments. The first of these is considering what is the right counterfactual for the female labor force participation rate. And then I'm also going to kind of add some more color and try and actually quantify what the potential long run effects of remote work might be, drawing on my own work. And then finally, I'm going to talk about why we should care that this was a she session relative to a man session. I'm grateful that Stefania showed actually some comparisons with previous recessions, even though we find that there are kind of minor gender differences in the pandemic relative to what we expected. This can still have major policy implications compared to the last few recessions. So Claudia already showed this figure 1 from the paper. What I want to do is just kind of zero in on this surge in female labor force participation that occurred prior to the pandemic. And what we're asking is really, should we draw a straight line here when we measure declines during the pandemic? Or should we draw a straight line, from mid-2019, or should we do something else? I think to answer that question, we need to understand what drove this surge. And in general, the fluctuations that have occurred in female labor force participation since basically the late 90s are more of a business cycle phenomena than anything related to a secular trend. So that's the fact that, basically female labor force participation rate leveled off in the late 90s, and now the fluctuations that we see are really just related to the business cycle. So to just starkly illustrate this idea that the reference month that you use to measure declines really matter, let's take April 2020 as an example. So if you use February 2020 as your reference month, you would measure a decline in the female labor force participation rate of 3.4 percentage points. If you instead compare to a year earlier, you would measure a decline of just 2 percentage points. So this reference month issue really does matter. And I'll point out that this series that I just showed is already seasonally adjusted. So it's not from a seasonal perspective that we would necessarily want to compare to a year earlier. It's really more, do we think that this surge was something kind of spurious, or that it would have continued had the pandemic not happened? So I identify in my discussion some features of this surge from July 2019 to February 2020. The first of these, as you just saw, is that this surge was part of a larger recovery of female labor force participation that began in late 2015 as the economy was, as the labor market in particular was finally recovering from the great financial crisis. The second feature is that this rise was sustained over 8 months. So basically what happened is that the rate rose a lot in July 2019, but rather than falling back, as we might expect if this was some sort of seasonal or statistical anomaly, we see that the rate actually stayed at that high level that it reached in July 2019 and actually continued to grow modestly, which again points in my eyes to the idea that maybe it wasn't some kind of anomalous rise that we should disregard. The third feature is that it was driven by employment rising, not unemployment. So these people that were entering the labor force, these women were actually finding jobs, which is a positive signal of their future labor market attachment as well. The fourth feature is that this was broad-based among different types of women. If you look at demographic subgroups, you see that participation rose within most subgroups, by education level, presence of children, occupations, etc. But it was highest among traditionally less attached or more marginally attached workers. And this is, I think, dovetails very nicely with the discussion from the previous paper about, the Fed describing its employment mandate as broad-based. As the cycle goes on, Powell has pointed out that, the most marginalized workers enter later in the cycle, and that seems to be precisely what was happening during this period. These tended to be lower income, younger, people with kids, etc. Sorry, I had one more. So the last thing I wanted to note is just that already by January 2022, the labor force participation rate of women had already risen to 76%, despite this huge kind of displacement experienced by many people during the pandemic. The participation rate recovered to a higher level than it had been any time between 2009 and 2019, up until July 2019. Which again points to the fact that actually maybe trend labor force participation rate was very high absent the pandemic. So the last thing on this point is that I follow an analysis that Claudia suggests in the paper and just do it in a more formal regression setup. We're looking at basically 4 groups of women in this analysis. So you have new entrants in 2017 and 2019. So the group that we're interested in is really the new entrants in 2019. And we're comparing both of those 2 groups to their counterparts who are continuously employed and looking at the propensity to exit the labor force in the next year. What you see is that new entrants both in 2017 and 2019 are more likely to leave the labor force in the next year, reflecting just this greater marginal attachment of new entrants to the labor force. But both continuously employed and new entrants in 2019 were more likely to exit the labor force in the next 12 months because of the pandemic, essentially. But when we interact this new entrant status with the pandemic, we don't see any additional propensity of these 2019 new entrants to exit compared to their counterparts in 2017 once we account for the effect of the pandemic itself. So again, this is suggesting that these weren't super marginally unattached workers that were entering. They look actually pretty similar to entrants in 2017. Okay, so the second comment is about these long-run consequences of employment flexibility for women. Claudia has been a pioneer in pointing out the job characteristics and job types that are kind of amenable to women taking them or more hostile to women taking them because of women's caregiving responsibilities. And these greedy jobs that require a lot of, face time, long hours in the office, or travel have been kind of one of the last big barriers to gender equality in the workforce. And she points out that this, if work from home arrangements persist, this might be very helpful in, closing the gender pay gap, allowing women to have more flexibility in the type of jobs that they take, et cetera. But she also offers the caveat that I think is well-founded that, what if only women continue to work from home and men go back to the office? What will be the implications of that? The reason that I think this fear is well-founded is because of some work that we did looking at time use data prior to the pandemic in this Alone et al. Paper that I'm on, where we found that despite the fact that men and women had basically similar ability to telecommute, women actually telecommuted 33% more. So women were taking up telecommuting at a higher rate, probably because they have higher caregiving responsibilities, and it's one way to kind of ease those. But in the latest survey data that we have on desired work from home post-pandemic, we see men and women reporting roughly equal desired work from home days, about 2.2 per week. So maybe the pandemic has shifted norms around take up of work from home, but really that remains to be seen, because this is a survey that asks people what they would like to do, not observational data of what people are actually doing. So it kind of remains to be seen whether this caveat will come true or not. In terms of quantification, in some of my other work, we developed this model of household labor supply and then use that to simulate a pandemic and a regular recession, and do some counterfactuals where we look at whether if these telecommuting arrangements persist, what will be the effect on women's labor supply and the gender pay gap. So what I want you to pay attention to here is the difference between the yellow line, which shows a persistently higher fraction of telecommuting jobs in the economy of 30%, compared to the green line, which shows a reversion to the pre-pandemic fraction of telecommuting jobs of 13%. And what you see is that the relative labor supply of married women compared to married men rises by about 2 percentage points according to the model. So this persistence of work from home allows women to work more and work longer hours. And this has implications for the gender pay gap in the model, because human capital accumulation occurs in the model when you work. So this greater labor force attachment of women as a result of telecommuting jobs speeds the recovery of the gender wage gap, because one prediction of our model is that because more women than men leave the labor market during the pandemic, the gender wage gap widens. Again, the yellow line is showing what happens if telecommuting stays high. The gender wage gap closes more quickly. Whereas if we look at the green line, we would see actually a very, very slow recovery of the gender wage gap back to pre-pandemic levels. All right, and then my final comment is about policy implications of she sessions relative to man sessions. Even though gender differences are smaller than many of us feared, this recession still looks quite different in terms of the gender composition of job losses, and Stefania also pointed this out. I would say that there's kind of 3 main differences between she sessions and man sessions that policymakers should be aware of. The first of these is kind of a reason that policymakers may not care as much about she sessions as man sessions. And that is that if you randomly sample 1 million women to lose their jobs and 1 million men to lose their jobs, the drop in aggregate labor income would be smaller in a she session, because women on average work fewer hours and are paid less. So the drop in aggregate labor income from a she session might be lower than from a man session. But how exactly that translates into aggregate demand depends on the ability of households to insure themselves against these drops in labor income. And as Stefania was pointing out, one important channel of insurance that households have is this family insurance mechanism that in typical man sessions, the secondary earner can increase their labor supply. But in a she session, the husband is often already working, and so there's no space for him to further increase his labor supply and offset the decline in his wife's income. And so households may actually be more constrained in she sessions because of the loss of this insurance channel, which might imply a greater efficacy of fiscal policy. And then the last point is about the speed of recoveries. So Stefania's work has shown that, in previous recessions, one important way that the economy has recovered is through increases in female labor force participation and female labor supply. But this might be less true in a she-session. So at the micro level, when we estimate labor supply elasticities by gender, we see that female labor supply is more elastic than men's. So women are slower to return to the workforce when they lose a job. And this might mean that, the speed of recovery from a she-session is slower. Okay, and then this is just coming out of our model to illustrate this point about MPCs and the efficacy of fiscal policy in pandemic compared to regular recessions. So here we're just plotting the MPC out of an unexpected government transfer in our model. And what you can see is that both for singles and couples, MPCs are higher in pandemic recessions and remain elevated for longer than in a regular recession. So I'll conclude here. I think the paper is really a vital look at women's actual experiences with the benefit of hindsight, because there have been so many kind of doomsday predictions. It's really important to go back to the data and see what actually happened. And the main takeaway is that while most women remained at work, they did have to increase caregiving time substantially. And at the same time, there were several million women who lost their jobs. And as I just pointed out, it might take longer for them to get back to work, and they might have bigger penalties on their earnings. And we've also gained some policy lessons for future she-sessions. What I want to end on is just kind of the big question that everyone in policy circles is grappling with at the moment, which is where will or where should labor force participation rates recover to? And when we think about that question, heterogeneity by gender may matter, because the drivers of female labor force participation may be quite distinct from men's. And there's this puzzle of why male labor force participation rates have been dropping. Similarly now for women, as Stefania pointed out, and I think that's just a really important question for future research.
Great. Thank you, Jane, and also Stefania and Claudia for those great presentations. We have a lot of hands up already, people eager to discuss more. I'm going to start with Bob Hall and then Betsy Stevenson. So Bob. You there, Bob?
Unmute. Thank you. Okay.
There you go. We got you.
Good. Thanks. Well, this is a great session. Very, really penetrating the data in good ways. But there's one subject that's, I think, key to understanding this that didn't get mentioned by either discussant or by Claudia, and that is there was a huge reduction in work starting in April of 2020. But almost all those people that account for the reduction in work did not lose their jobs. And that has permeating effects when you're looking at the rest. For the snapback from the recession was vastly faster than from any other recession, because workers were recalled to existing jobs instead of having to try to find other jobs. So there was a huge pulse in 1 month, April of 2020, which accounts for all of the bulge of unemployment that takes the form of not lost jobs, but just lost work. And then all the dynamics you see after that are dominated until that component, the temporary layoff component of unemployment, was dissipated until around the early fall of 2021. So it's no longer an influence, but I would advocate everyone working in this area to pay close attention. It's everything. I think the work that's being done, especially the focus on participation, is appropriate because since these people became unemployed, they were still counted as participants. So there isn't a first order problem, but I think there's a lot of kind of second order issues. And you certainly should never talk about people losing their jobs. What they lost was their work.
Okay, we'll take a few questions and then go back to Claudia and Stefania and Jane. So Betsy and then Carolyn Hawksby.
Sorry. Okay. Thank you. So my comment was, I wanted to talk about what's the right counterfactual. I will say Jane did such a good job discussing that there's not that much left for me to say. But I do think that really is such a crucial question. And the one thing I wanted to add to what Jane laid out was that if we looked at the job growth that happened between 2015 and 2019, it was very, very steep job growth in the service sector, in the types of jobs that women tend to hold. And, when we got to February 2020, we still had 1 million fewer jobs in the goods producing sector compared to when we started the 2008 recession. But we had added 15 to 16 million jobs in the service sector. And so job growth was occurring in a place that was where women tend to work. And the thing that I worry about a lot right now is we haven't had a full recovery in demand for services. But what if we go back to wanting the kinds of services we had in 2019 or 2018? Will we have the same number of workers available? And so, that a lot of that's going to hinge on how many women come back. And so one other aspect just on what's the right counterfactual is it's not even just was the end of 2019 seasonally adjusted the right counterfactual, or was projecting the growth rate we were seeing between 2017 and 2019 the right counterfactual, which means, there's even further to go. And I think that's just a really big question out there. And then one last point I wanted to make was, I hear what Bob Hall just said. People didn't lose their job, they lost work. But actually, Claudia, what you discussed with the childcare responsibilities, what I've seen in surveys that I've done is that people made other accommodations in which they reduced work that doesn't show up as employment. They may have turned down a promotion, they may have stopped training, they may have just put in slightly fewer hours. In a way, those kinds of effects on people's career paths, their jobs and their earnings, we haven't even fully begun to see. And what I saw surprised me in the data is that those kinds of effects were hitting men and women equally, and reflects the fact that men went into the pandemic way less satisfied than women with the amount of time they got to spend with their children. And actually, the upside of the pandemic for fathers seemed to be that they liked all that extra time with their kids. And so there might have been a shock to preferences, which comes back to Jane's point about now that we have the opportunity to work from home some more, will men take more advantage of this than they did prior to the pandemic? And that will make a huge difference to the path of gender equality, the answer to that question.
Right. Thanks, Betsy. I'm sure Claudia will come back to that at the end. Next is Carolyn Hawksby, and then Austin Goolsby on deck.
First, thanks to Claudia for a great paper and to Stefania and Jane for great discussions. So my comment is pretty straightforward. I think it's great to look at labor force participation. It's great to look at employment. And of course, it's really important to look at caregiving during the pandemic. But as much of Claudia's work has shown, especially for college-educated women, there are career concerns associated with continuous employment and the degree of engagement in work. And part of what I'm interested in is whether women were more likely to be what I would call distracted workers during the pandemic because they were trying to multitask and do childcare and maybe some homeschooling along with work. And if they were more likely to, let's say, participate in a Zoom call, but be on the phone or have their camera off the whole time, or if they were having to take breaks in order to see to a child who was, being very distracting in the room that they were trying to use, as opposed to, say, the male in the family who might not have had the kids in the room with him. And if they were simply being less productive because they were having to do so many things at the same time, those could have long-term effects, even though they were participating the entire time and even though they were employed potentially the entire time. And I would think especially for college-educated women where those sorts of engagement and career concerns can be a big deal. So I'd like to hear Claudia's or Jane's or Stefania's comments on that. Thanks.
Thanks, Carolyn. Austin Goolsby, and then Steve Davis.
Okay. Can you hear me?
Yes.
I unmuted. Okay.
Yes.
I thought two things. One was related to what Caroline just said. Interestingly, productivity in most of these sectors, at least a rule of approximate rule of thumb of productivity, is that productivity went up in the pandemic. So overall, real GDP's up several percent from before the pandemic, and the labor force is not back to where it was before. So the just loose labor productivity for the whole economy is up 4 or 5% versus pre-pandemic. And in a lot of the service sectors, Chad Severson and I have looked at restaurants. Restaurant productivity went up. A lot of the service sectors went up. So it's interesting that in a way that hasn't been reflected in the wages. But the second thing that Claudia, the results seem to emphasize, let's call it the difference between the aggregate and the cross section. So there was that piece by Furman, Carney, and Powell, which said you can see the effect of childcare on labor force participation, but it doesn't contribute to the aggregate nearly as much as you would think just looking at the numbers, because one group seemed to be replacing the other group. And I do wonder, now that we're in a market of extreme labor scarcity, is it the case that you see this kind of substitution, that it's employers hiring women without children ahead of women with children because they have the higher childcare responsibilities? Or if you compared across industries where at the pre-pandemic, men and women are in the industry equally, does it look like there's substitution away from women toward men in those industries? I think that would be kind of fascinating, and kind of fascinating to look at the issue of the child penalty. So is it the case that women with small kids are falling behind, that the penalty for having a kid in some sense is getting bigger precisely because they can't go back to work at that moment?
Good. And the next question I have is from Steve Davis.
Yeah, thanks. A few comments. First, to Bob Hall's point, I just want to add to what he said. There was a huge burst of temporary layoff unemployment. There was also a huge atypical exit from the labor force. So many people went from employment to non-employment or non-participation. Those people weren't on temporary layoff recall, and they've had a much longer path back. Second, there's an undertone of concern in much of the discussion about what higher rates of working from home might mean for women and their career prospects. And I get all that, but it's also worth remembering when you ask people, which we do regularly in our survey of working arrangements and attitudes, would you like to work from home? Many of them, not all of them, say they would like to do so part of the time. When you ask them, well, how would you view it in terms of an equivalent? How would you view the option to work from home 2 or 3 days a week to an equivalent pay increase? The means range from about 5 to 8% of earnings. That's a big, big number. You also see that when you ask people, if your employer says you must come back to the office 5 days a week, what will you do? 40% of them say they'll look for another job that offers the ability to work remotely. So I do think we want to keep in mind that despite misgivings or concerns we might have, many people, maybe most people, have a strong desire to work from home, to have that flexibility to do it part of the time. And then to Betsy's point, we also ask men and women, what their employers told them about what their long-term working arrangements will be after the pandemic's over. And there we see that men will do more working from home than women, which you might say, okay, that's great. But the fact is, and there's the other take on it is the gap between what people want and what they'll get in terms of the option to work from home is bigger for women than for men. So I just would encourage a little bit of maybe more thinking about the upside of the flexibility that comes with working from home.
Okay, thanks, Steve. We had a couple of late entries, so I'm going to ask Olivier Blanchard and Bob Gordon, starting with Olivier, but with short questions so we can get back to the author and discussants.
Short and predictable question coming from me, which is differences across countries might help a lot in identifying things. I mean, if I think about France, there was free childcare, which clearly must make a difference. We kept the schools open throughout, and we had an explicit partial employment system in which people could basically decrease the number of hours. It seems to me that each of these factors should have implications for what happened to the participation rates of women. So I know that that's much beyond what Claudia can do, but to the extent that she knows anything about it, it would be great.
Good, thanks. And last question from Bob Gordon. You there, Bob?
Yes, can you hear me now?
Yes, we can hear you. Go ahead.
Yes, two comments. One is further international perspective on Bob Hall's comment that we lost work, not jobs. If you compare Europe to the United States, you see that we lost a lot of jobs, and the federal government expenditures were on unemployment compensation, whereas in Europe, there were central government subsidies for people to keep their jobs and just work less. So this contrast between working less and job loss is much greater in between Europe and the US, suggesting there was a lot of job loss in the US. There's been a mention about productivity, and Austin mentioned restaurants. I've got a data set now for industry differences in productivity during the pandemic. And what is really noticeable is there's a huge difference if you look at the service sector, which is 2/3 of the economy, between what I call contact services, which are those which involve close contact, and those where people could work at home. And we have had a huge differential between an increase in productivity in work at home versus a decline in productivity in contact services. And I'd like to relate this to the work of Nick Bloom and Steve Davis, which has shown that to some extent, there is an explanation for the increased productivity of work at home, because according to what I've heard from Nick, we've had people's commute time has been substituted for work time rather than at home leisure time. And so assuming the BLS is not measuring this increase in hours per job, that suggests that some of the increase in productivity of at-home work may be a measurement issue. And I think this is worth pursuing. None of this relates to men versus women, I would admit.
Right, thanks, Bob. Great point. So lots of good comments from the floor. Let me turn it back over to Claudia, and
Sure.
you can pick and choose what you want to respond to,
Yeah,
Claudia.
and I'm going to do this very quickly because this is all for the future. So first of all, I thank the editors and I thank Stefania and Jane for not just excellent comments now, but they improved the paper in the background, which no one has seen. So let me begin with various comments to begin with Bob's comment. In many ways, hidden in the paper and in the comments given is exactly what you're referring to, because the non-employment numbers are including the ones, that's why we call it at work, are including those who had jobs but were not currently at work. And so that was sort of built in to what I did and what many people did during the pandemic. The second point raised by various people, begun by Caroline, is the notion of the distracted workers. Very important questions about long-term issues. There are a couple of interesting papers. I cite some of them. For example, we academics, we have very good information that we produce, which is our working papers. They're leading indicators of where we're going to be later. And it is distressing and disturbing that women, particularly those with caregiving responsibilities, have produced fewer working papers. So, I hate to say that terrible times lead to more research, but it's pretty clear that that there's going to be a lot of interesting research in the future about what the long-term implications have been. The other point, which has been raised by various people, has to do with productivity changes. Implicit perhaps in what they've said is that in some of the service sectors, there has been changes in automation, certainly in restaurant ordering, in checking out, even going to the doctor, the veterinarian. There are fewer people who are taking your credit card. You just put it in. So there have been interesting changes in terms of automation. That doesn't get to Bob Gordon's point that in fact those areas have not seen the greatest increases in productivity, maybe in the future. So with that, I turn it over to others, but thanks very much to everyone, and to Olivier Blanchard. I will go to France and I will do my research there. Thanks.
I'm glad we sparked that, Claudia. And Jane and Stefania, do you want to each take a minute or less and hit your highlights in response to the discussion?
I just wanted to follow up on Betsy's comment, which I thought was very interesting. So she mentioned that, after the Great Recession, effectively manufacturing jobs didn't fully recover, and we saw a big growth of service jobs, and those jobs were taken by women. And this has been like a constant of recent recessions. So it was the case in the 1991 recession and 2000 recession. So in some level, manufacturing jobs do not recover. Those primarily employ men, and then in the recovery we see a growth in service jobs. And so with respect to this particular pandemic, going back to the issue of automation, so one of the ideas behind the lack of recovery of manufacturing jobs in past recession was that when the economy recovers, firms adopt labor savings technologies, and so they don't hire back the workers, and that service jobs are less susceptible to this because they're care jobs for the most part. So in our paper, we looked at the susceptibility to automation of these occupations that were most hit by the pandemic, and about 33% of workers in the occupations that were most hit by the pandemic, mainly service occupations, are in positions that are highly susceptible to automation. And that's actually very similar to the susceptibility to automation of in the occupations and industries that are usually hit by a recession, so manufacturing, construction, and so on. So that sort of going forward, we might see some of the dynamics that we saw in past recessions for manufacturing jobs may be translated in service occupations as well.
Jane, want to wrap it up?
Yeah, just very quickly, I wanted to touch on Steve's comments that, people value a lot work from home, and they're reporting that they're going to, move jobs to look for more flexible arrangements. I'm definitely very sympathetic to that, and I've seen that in many surveys too, but actually the experience of kind of doing this work made me a bit mistrustful of what people report versus what people do, because a lot of these headlines that Claudia showed in the beginning of women saying, I'm going to leave the workforce, I'm going to completely scale back, I'm not going to seek a promotion. Actually, a lot of that didn't come to fruition. So it's almost like people express this kind of like pain or dissatisfaction in these surveys, but then their behavior can look very different. So again, like we may see, one thing I wanted to do was talk about the Great Resignation and quits, and what are the drivers of quits. Is it really more flexible arrangements? but that data is not really available yet by gender. But I just think we need to at times be mindful of differences between what people express they're going to do versus what people actually do.
Great. Thank you, Jane and Stefania and Claudia. That was a terrific session, and also all the comments from the floor. We'll take a break now and come back at 3:40 with the decentralized finance paper. It's 2:40, so why don't you go ahead, or in Chicago, it's 2:40. On East Coast time, it's 3:40. Why don't you go ahead and share your screen, Antoinette, and we'll start the next session on cryptocurrencies and decentralized finance. The presentation will be by Antoinette Shore.
Great. Can you see my screen?
Yep, looks great.
Perfect. Great. Thank you very much for having us. In particular, thank you to the organizers and to our discussants for very helpful comments. This is joint work with Igor Makarov, who is at the LSE. And this paper is about cryptocurrencies and decentralized finance. In particular, decentralized finance and cryptocurrencies have one distinguishing feature, which is they are built on the blockchain technology, which offers a possibility for an entirely different financial architecture. In particular, it allows record keeping to be decentralized and to be accessed, the system to be accessed in an anonymous and unrestricted, or often this is also called permissionless fashion. And advocates of this new architecture have pointed out and they argue that it can replace traditional financial institutions. And in particular, the hope is to reduce rents, to reduce transaction costs in the current system, and to democratize finance by allowing a much more level playing field among providers. So it's important to understand the key building blocks of this new architecture. There are two. The first is the blockchain itself. You can think of this as the base layer, which is an open source and permissionless ledger that provides this decentralized record keeping. Famously, right, cryptocurrencies like Bitcoin or Ethereum are that type of base layer. But then on top of this blockchain or this ledger, we can build in the more modern blockchain smart contracts. For example, in Ethereum, you can build these smart contracts. Think of them as self-executing algorithms, almost like little computer codes that are embedded in the blockchain and that allow participants to actually interact in more sophisticated ways with each other. In particular, right, and that's the topic also of today, is that one can build these decentralized finance or DeFi applications that use smart contracts to then perform financial functions. For example, right, decentralized trading or lending, etc. Let me, kind of at a very high level and simplified visual way, show you how this type of architecture compares to our, traditional one. So the traditional financial architecture, as you're all aware of, right, basically flows through centralized intermediaries or these centralized nodes. Say, a customer would access a bank and either, get a loan through a bank. Similarly, right, centralized exchanges as intermediaries would function as these centralized nodes. And of course, in this type of system, these financial intermediaries perform a record-keeping function. They also perform the financial function, say, for example, right, in an exchange to allow you to trade shares with other participants. And then, of course, however, they are also tasked with guarding the access to the financial system. If you want, right, they enforce KYC norms, know your customer norms, guard against money laundering, tax evasion, terrorist financing, and so on, right? Now, the concern in this type of system is that if one of those important centralized nodes fails, right, either because there is an attack on this node, or maybe because the node itself becomes corrupt or front runs its customers and so on, that would be bad for the system. And so decentralized finance, in a way, flips this architecture or undoes the reliance on centralized nodes, and instead replaces these centralized intermediaries with a completely decentralized system that relies on decentralized verification of transactions through the blockchain. And then the DeFi apps, if you want to think of them almost as decentralized algorithms that allow anonymous participants to come together and interact with one another on the blockchain. So, this is obviously very stylized. In the paper, we provide a much more detailed introduction to how the different layers of the DeFi system works and some of the nuances. I don't have time in this short presentation to go through this, but please feel free to look at the paper. What I want to focus on in the talk, however, is basically to lay out a critical analysis of the economic forces behind these DeFi applications. And in particular, I want to basically point out the implications that DeFi apps can have for many dimensions of the financial system. And some of the very important ones that I want to focus on is data privacy and transparency, economic rents, transaction costs, how governance is structured on such a decentralized system, and systemic risk. And at the end, hopefully, we have time to discuss what regulatory challenges exist and sketch out possible solutions. Okay, so let me start with kind of the first big challenge, if you want, and area where DeFi will or has already changed kind of the architecture. So as we just discussed, right, in traditional financial intermediaries, those central intermediaries are tasked to solve basically a trade-off in society between, on the one hand, protecting individual people's privacy when engaging in financial transactions, right, so that your data doesn't end up on the internet. But then at the same time, society also tasks them with preventing money laundering, tax evasion, anti-terror, kind of not allowing terrorist financing to flow through this. In contrast, right, these permissionless cryptocurrencies that allow anonymous parties to interact on the blockchain ensure privacy by never even collecting any personal information of address or account holders. And then on top of it, DeFi applications actually reinforce that anonymity because, as I just showed you, right, they remove even any centralized intermediaries that potentially could actually interact with the blockchain. And so by removing those centralized nodes and automating contract execution, right, you make it possible to say trade on a DeFi exchange with ever needing, say, to touch a central record keeper that could, for example, enforce KYC checks or help with, kind of tax collection and tax enforcement. So this is, in a nutshell, right, means that actually these type of DeFi solutions create externalities for the rest of the economy that currently, in the current regulatory framework, right, are not internalized by market participants. And of course, as a result, then, if we allow this to persist, create a big subsidy to that part of the economy. And, kind of as I was mentioning before, right, impedes functionalities like guarding the financial system against bad actors interacting through it, or other malfeasance, right? But this is one of the really key challenges that regulators will have to face. And I will come back to this because lots of other regulatory challenges in a way hinge on this central kind of issue. So let me now go to a second really important dimension in financial systems that we care a lot about, right? Which is how economic rents are allocated in the system. And in particular, there is always a concern, right, that intermediaries collect excessive rents in the system. It's important to understand that in financial markets, there are inherent economic forces that make competition or free entry into the system actually less effective in dissipating the rents, because financial markets often are subject to frictions such as network externalities, economies of scale and scope that endogenously, right, create constraints for competition. And so the same is true in the DeFi architecture too. And this is something, where in the paper we spent a lot of time laying out that actually it's not automatically the case that there are no rents in DeFi. In fact, within the layers of that architecture, you again can actually have economies of scale and scope creating, excess rent. So just to give you briefly some examples, we show, for example, that the validators who validate transactions on the blockchain, in Bitcoin they're also called miners, right? They have built an incentive to be concentrated, economic incentive to be concentrated, which then actually creates possibilities for collusion, and with it might undermine the integrity of the blockchain. But even if you go to the next layer, right, to the smart contract platform in the individual DeFi applications themselves, we again actually see that there are that network externalities can limit competition. So, if there is, say, one dominant platform where lots of smart contracts might live on, say like Ethereum, right, you might actually have network externalities that then lead a lot of new applications to also be built on that platform. And that could then actually lead, say, to, the smart contract platform provider to change its fee structure, right? Finally, I also want to point out that in financial markets, it's often also the case that actually at the customer level, lack of financial literacy or behavioral biases can lead to rent extraction by counterparties if customers don't understand, say, that contracts are written in a shrouded way or not, kind of optimally, are not optimizing their interests. And, in all these type of frictions that I just laid out, we have seen that in the more traditional financial system, regulation can reduce excess rents when competition fails. This, of course, is in a completely permissionless and anonymous system creates a lot of problems, because we wouldn't even know where to attach, so to speak, the regulation, right? And so there, basically, the anonymous and permissionless structure of the ecosystem will impede regulators. If we turn to, kind of the promise of lowering transaction costs in the system, here obviously is one area again where in the traditional finance system we are typically quite concerned, right? That if we have these centralized intermediaries that have these exposed positions, they might have limited incentives to invest in new technologies, even if those are welfare improving for society. Just, they might be costly for the central intermediary. And I think these are exactly the places where the blockchain technology has great potential to reduce some of these transaction costs, if you think, for example, about automatic clearing and settlement, I think there can be kind of lots of improvements. In fact, I would even argue that the introduction of cryptocurrencies, if you want, even just the threat of the introduction, seems to have provided some incentive for financial service firms to upgrade some of their infrastructure and to actually reduce costs. So, kind of there are definitely, kind of potential positive effects from this technology. But I also want to point out, again, as in the traditional financial markets, we shouldn't take those benefits for granted, because as with, say, a major bank or a major exchange in the traditional financial system, once one platform, say, or one blockchain becomes dominant, the same types of disincentives to innovate will exist for them that exist in the current system, right? So, for example, famously, right, we've seen that Bitcoin miners have, kind of resisted the call to move to greener technology and so on, right? And kind of that's not surprising, given, they also live in an economic environment as, traditional banks. There are two more things I want to mention. So in terms of, kind of these new applications, DeFi apps that are being built on the blockchain technology and with smart contracts, right? As with a typical type of firm or typical type of company, right? They have a number of different stakeholders, such as developers, the investors and venture capitalists that invest in them, and the users that can have diverging interests. And so governance rules are needed to provide coordination for action, if you want, and to provide incentives to adopt value increasing investments and basically changes. And of course, also to prevent large, powerful insiders to take advantage of minority stakeholders. Now, in kind of a large history of governance research in finance, right, we basically have come to the conclusion in finance that the most effective ways of solving some of these governance issues is via recourse to the legal system. So, right, minority shareholder protection, fiduciary duties, and so on. But as you can already feel, right, this reliance on off-chain governance, of course, clashes with the purist maxim of cryptocurrencies and this trustless trust architecture. And we have seen actually a lot of interesting experimentation with on-chain and decentralized governance, where, kind of governance tokens are being issued so that, say, every user can, kind of can vote on the blockchain. These are often called DAO, decentralized autonomous organizations. But in a nutshell, from what has happened so far, you can see that those type of decentralized governance system have exactly the free riding problems and coordination problems that kind of we have found in typical applications in history as well. And so actually those type of solutions don't seem to work very well. And in fact, interestingly, we show in the paper, for example, that the majority of DeFi apps, especially very successful ones, actually end up having very concentrated ownership, and ultimately, right, are not relying purely on on-chain governance. So let me finish, kind of my discussion of these, economic forces that are important in understanding the DeFi ecosystem by talking about systemic risk. I want to say that, so far DeFi has primarily operated in, kind of what you could call in quotation marks, a narrow banking model. So basically loans are collateralized in the system and there is no fractional reserve system here. But despite, if you want, this limitation, we should be concerned that there is potential for systemic risk from a run on stable coins, and also the ability of investors to take very highly levered positions in DeFi apps. So, I will actually leave discussion about stablecoins to Gary Gorton, who is going to discuss the paper because he has written very interesting, work on this. I just want to point out that in the current system, you can see that actually some exchanges allow participants to take 100x leverage positions. And in addition to actually use multiple interconnected contracts between different apps and between different blockchains, which can make the system very complex and fragile. Just even, yes, it is all on the blockchain, but just even understanding these interconnections is often absolutely not straightforward and can create fragility. So I think in
the wrap up comments, Antoinette. So make sure you have time to make your closing remarks.
Exactly. So in my last minute, I just want to say, so to wrap up, right, what we want to highlight in this paper is that indeed regulations will be needed to address some of these issues that are that we lay out in the paper. And in particular, we believe that the key challenge for regulation really stems from the anonymous and open access nature of the system. And so if we appreciate that this is where the core issue lies, a natural solution for regulatory oversight then is at the level of validators and developers who control the network protocol. If actually regulators could work with those validators to make sure that only certified participants, say participants who actually follow KYC norms, who are not tax evading and so on, if only they are allowed to function on the blockchain, right, we could build a much more clean, if you want, ecosystem. And in fact, what would be also great about it is that actually different countries could agree that if they agree on KYC standards, they could all use the same blockchain, while countries that don't want to be on that same, say, KYC standard could then fork off into their own blockchain. And then everything else that we like in financial regulation, or also, need to improve, right, could basically be built on top of that base layer of certification. Finally, right, I want to say that if we can't get to work with validators, actually the options for regulators will be much more limited, and they will actually in the end be left to the goodwill and voluntary cooperation of validators and other participants on the blockchain. And finally, let me also say, we shouldn't wait too long in figuring out how to regulate this whole ecosystem, because cryptocurrencies and DeFi apps can become too big to regulate given all the network externalities that we discussed before. So in sum, right, DeFi apps, and this whole ecosystem are still evolving and developing many new functionalities, and there's lots of potential exciting new things that could happen. But the potential new solutions in the current form create large negative externalities on the rest of society, if you want. We suggest in this paper that there are ways to actually regulate against these issues while preserving most of the desirable features of the blockchain architecture. But we think this is really important to get right, because it has implications for the integrity of the financial system in the US, but also for international financial competition and basically allowing a system that doesn't facilitate bad actors from abusing it.
Good.
Thank you very much.
Yeah, thank you, Antoinette. The first discussant is Gary Gorton.
Okay, can you hear me?
Yes.
Okay, good. This is a really interesting and important paper. The reason is that although it's early days in DeFi, it's going to be important that everyone who's involved in policy or regulation understands what's going on, as Antoinette said in her conclusion. And this paper, if you're new to this area, you can read this paper and you can get an overview of the issues and how this works and what the terminology is. And so for that reason, it's important. And I'm going to give you some other ways to think about its importance. Here's the growth of DeFi funding. This is from today's Financial Times, and you can see it's about 250 billion. Recently, it's gone down. And this report says basically summarizes some of what Antoinette was saying, that there's these hidden risks, and the global regulatory body, this is the International Society of Securities Commissions. So I'm going to talk about why this topic is important, and then I'm going to talk about the premise of DeFi, and I'm going to expand on some of the things that Antoinette talked about in the paper and talked about in her talk. And then if I have time, I'll talk about whether DeFi can ever disrupt banking and what would have to happen if DeFi is going to disrupt banking. So there's
Gary, sorry to interrupt. We're getting a blurb about subtitles that's blocking the view, and we're also seeing presentation mode, but there we go. That's
good.
Yeah.
Are we good? Okay.
Yeah.
So there's about 250 DeFis, and there's essentially a tournament going on, and only a few, I would think, are going to survive. And that's very similar to what happened in the auto industry, where there was a handful, 30 companies in 1899. And by the end of the next decade, it was 485. And then it went to 253 in 1908, and it ended up with four General Motors and Chrysler. And that's the same with the network effects. You forget that the internet began in 69, and by the 1970s, there were 300 networks that were not interoperable. They couldn't talk to each other. And we had to wait for computer scientists to come up with packet switching, which allowed these networks to become one network. So currently there's about 1,500 blockchains, and they're like the early days of these networks. They're not very interoperable. To some extent they are. They're not very scalable. And crypto space is not interoperable with the current financial sector, including banks and the payment system. So computer scientists are hard at work on lots of this stuff. And we're going to see technological change, which is going to change this. Now, the premise of DeFi, as Antoinette explained, is that there's no central authority. Instead, there's a governance mechanism, and it's based on tokens. And so the implicit claim here is that there's no agency costs, and that by eliminating agency costs, DeFi is more efficient. So we replace a CEO with this governance mechanism. And as Antoinette said, agency costs is the central paradigm of corporate finance for the last, 50 years or so. And the basic story is that managers are entrenched due to the separation of ownership and control. And there's evidence for this. I think my favorite evidence is by Alexander Dyke and Luigi Zingalis, who looked at trades of blocks of stock. And they find that there's a 14% premium when you buy a block. And essentially, you think of that as the present value of the private benefits that you're going to get as a stream, right? But there's also benefits to delegating tasks to experts, right? That's how corporations are organized now. We delegate tasks. And in this paper by Bennetson et al., they look at CEO deaths and deaths of CEOs' immediately family members, and they find that CEOs' deaths and family member deaths are strongly correlated with declines in firm operating profitability, investment, and sales growth. The paper was never published, but it's a very good paper. Now, does this decentralized governance actually work? And in one study of MakerDAO, which is probably the most famous DeFi, Sun et al. Found that, in fact, it doesn't. And Antoinette was talking about how there's these concentrations. They found that By examining maker governance polls, we find that voters are centralized in a small group, and voting power is unequally distributed among these voters. In most voting activities, the largest voters could account for a significant number of the votes. So in effect, some of these participants become agents and the others become principals. And some agents have more expertise than others, and other agents' sole job is to pay attention to the tasks, okay? So the group that really controls this, and this is something Antoinette said, is that DeFi developers essentially control this. And it's likely that there's always going to be a group that does the control because many of the users don't have the expertise to vote on whether the code should be changed. And they don't have the attention to devote to this and really think about it. So this is the same report that was discussed in the FT. Most DeFi protocols rely on centralization in one or more areas. And there are protocols that have a hidden centralized authority and are decentralized in name only. Well, okay, fine. Well, we do have other governance forms, and one of them is cooperatives, right? So you might think a DeFi looks a lot like a cooperative. And there's famous econ papers about these plywood cooperatives in the Northwest. And there's an issue there that was pointed out by Henry Hansman in a famous book, The Organization of Enterprise. And this is Holmstrom's kind of summary of the argument. Collective decision-making is always difficult, but is more difficult the more the interests of the parties diverge. A group with common interests will have a much larger time to reach a good decision than a group with divergent interests. And the problem with DeFi is that you have these divergent interests that Antoinette was pointing out. So for example, in Compound, another well-known DeFi, 46% of the tokens were distributed to shareholders, but 54% was left to the developers, right? So they basically control this thing. So let me turn to the next issue. Will DeFi disrupt the banking system? Well, currently DeFi activities are self-referential, meaning that all the activities occur in crypto space using cryptocurrency. So borrowing and lending is all in some cryptocurrency. DeFi derivatives are basically written on Bitcoin, and there's no link to the real world, right? I mean, you can't get an interest rate swap on a DeFi. And many of these activities are essentially zero-sum games. So, I mean, a lot of this looks like it's a game in general. And perhaps at this point, maybe it is. I think it'll evolve not to be a game. Stablecoins, however, are not DeFis. These are banks. These are coins that are purportedly backed one for one with cash or safe assets. And their terms of service say they are redeemable at par on demand. And their peg holds about 85% of the time. Now, if you're going to be a bank, you have to issue short-term debt, right? So there is one I'll come to, but these guys already are disrupting things. So according to, this was one of my PhD students, a 1 standard deviation change in the daily issuance of the top 3 stablecoins results in a 7% increase in commercial paper issuance the next day, all right? So stablecoins are already part of the money markets, even though they appear small. Now, MakerDAO, which is, as I mentioned, one of the biggest well-known DeFis, they have a coin called DAI. And DAI is all on-chain, and a user deposits collateral, which can be Ethereum-based cryptocurrency, for a loan of an equivalent amount of DAI. And there's a lot of rules about how this is supposed to work, which I won't go into. But DAI is only, pegged to 53% of the time, compared to about 85% of the time for the off-chain guys. So remember that the stablecoin issuers keep the backing assets off-chain. So it has to be physically somewhere, right? And if they buy commercial paper, they are actually financing corporations, right? So there is a link to reality, right? Now, DeFis could make loans to banks, but they would have to have access to big data, especially proprietary data, if they want to act like, say, Ant Financial. But they would still have to have something to actually lend. They would have to give a stable coin to a corporation, and that stable coin would have to be able to interact with everything else in the world. And that I think we're probably a long way from. So And that's because there's no interoperability. So there's two kinds of interoperability. One is between chains, and the other is between DeFi platforms and the current payment system, okay? So, you know, I can imagine that there would be banks. I don't think they would be DeFi, but I think there would be banks. But to be a bank, you have to be linked to the existing payment system. And effectively, that boils down to having a master account at the Fed. And the Fed has consistently refused to grant master accounts to any bank based on new technology. They never say no, they just don't say anything. So if you sue them, as I have with a bank I'm involved with, you know, the judge says, well, it's not right. In other words, they didn't say no, so you just have to wait around for years. And of course, they're never going to say no. So the Fed has basically just refused to engage with the new technology on any level. And this is just not a good policy stance at all. So this space is growing at warp speed, and it's important to keep up with it. And even as we, you know, have this conference, I'm sure things have changed in the DeFi space. Thank you very much.
Thanks, Gary. The second discussant is Eswar Prasad.
Okay. All right. So Igor and Antoinette have done a terrific job of providing a paper that is a really nice entree into this new, exciting, and in some ways scary area of finance. So they provide some very useful analytical perspectives as well, and rightly skeptical about some of the claims made by DeFi proponents. So what I want to do in my discussion is basically provide some perspectives in terms of both the marvels of this technology, and I think in some ways it truly is marvelous, and also provide some frames of reference for thinking about where DeFi might or might not fulfill the promise that it has set out to fulfill. Now, Bitcoin, of course, set off this entire revolution, and if you think about what Bitcoin attempted to do, at some level, it was quite remarkable. So if you want a system for conducting transactions without a trusted intermediary and to be able to do so without even revealing your actual identities, the technical challenges are enormous. You know, each of these challenges would take a great deal of innovation to get around. But the remarkable thing is that Bitcoin solved all of these. It solved this in a remarkable fashion using what I think of as a radical transparency, basically posting all the transactions ever used with Bitcoins and all the digital identities of the transacting parties on these digital ledgers, and set up a mechanism whereby there was an incentive for people to go out and use computing power in order to validate transactions. So what Bitcoin has accomplished really is quite remarkable in creating the system that does allow for transactions to be validated, that is remarkably secure in many ways, and that actually also preserves at least some degree of anonymity. The problem is it doesn't work at what it was supposed to accomplish. It's not a great medium of exchange, so it has very unstable value in addition to a variety of other technical problems. In addition, the consensus mechanism, proof of work, which is very nicely explained in Igor and Antoinette's paper, is not very efficient. So it doesn't work very well. But it has set off a motion to try to get around some of these problems. And as I will argue, and as the paper shows, getting around each of these problems of Bitcoin, which is in some sense the original DeFi project, creates a set of new problems and comes at the cost of some degree of compromise in one dimension or the other. Gary has done fantastic work on stable coins and the risks they pose, and stable coins get around one of the key problems of decentralized cryptocurrencies such as Bitcoin. That is that they have very unstable value, which makes it very hard to use them as reliable mediums of exchange. So in a sort of delicious irony, stable coins get their stable value precisely by being backed up by stores of fiat currencies. And it's ironical because the whole point of Bitcoin, which emerged from this libertarian zeitgeist, was to get away from fiat currencies. Now, what is the compromise that is required for stablecoins to work? Essentially, you have to give up the decentralized validation mechanism. You have issuers of stablecoins who, at least in principle, are going to maintain stocks of reserve assets and who then undertake the process of validating transactions. We've all heard about, Facebook or Meta's doomed project, doomed largely by the hubris of Meta, but almost inevitably we're going to have new stable coins. Some of these are already out there, as both Antoinette and Gary have pointed out, and more are to come because at some level they're trying to fulfill a real latent demand for better payment systems, both domestically and internationally. But this raises a whole set of issues about who is going to regulate the validators, who is going to make sure that these do not pose risks to the traditional financial system, just like money market mutual funds did in the lead up to the global financial crisis. But at least with stable coins, we know who to regulate. Now, it's worth stepping back a little bit and thinking about what exactly is decentralized when we think about DeFi. And there are three parts to it, really. It's decentralized architectures. So as Antoinette pointed out, you don't have a centralized point of failure. You also have decentralized governance. You don't have control existing with a small group of people or an individual issuer. And you have decentralized trust. There is no particular institution or agency that you need to trust in order for this to work. But the system as a whole is logically centralized. Now, there are many advantages to this, at least in principle. Again, Antoinette has pointed to some of these already. The fact that it is resistance to attacks, it is fault tolerant. In principle, at least, it is difficult to collude. And there are a variety of benefits to it in the sense that everyone can, in principle, have access to this. It is censorship resistant and it is open. So at one level, there is tremendous promise in DeFi in terms of getting financial systems to do much of what they're doing in slightly more efficient ways and in ways that provide much broader access. Now, again, as you think about what DeFi is trying to accomplish, it sounds fantastical at one level. And yet, the remarkable thing is it works. But it works with some qualifications. While there are certain parts of it that work very well, again, as Antoinette has pointed out, some of the key elements of DeFi don't seem to hold up as well as they should. In particular, while DeFi is by definition supposed to be decentralized, the fact that you have incentives built in that lead to more collusion, that make it more centralized in order to work more effectively, with stable coins being a prime example, is, I think, one problem. But having said that, there are certain parts of DeFi that do work well. I mean, if you think about smart contracts, and here is a simple illustration of a smart contract, which is very basic in terms of functionality. The existing smart contracts that actually work out there have far greater functionality. In the computer science literature, it's typical to talk about Alice and Bob. So I have to be a little more, with the times. So I have Alicia and Carlos trying to trade contracts. And so long as you can tokenize whatever assets they're trying to trade, be they financial assets or tokenized versions of real tangible assets that can be posted in terms of their ownership records on the blockchain, you can actually use these smart contracts on blockchains to conduct these transactions very effectively. And these two actually work very well and with a degree of security that does seem mind-boggling, but actually works quite well. We also have a variety of new products that are beginning to appear thanks to DeFi. And these are very interesting features. Let's take as an example what are called flash loans. Now, flash loans, again, are mind-boggling. What they essentially do is allow people to conduct certain financial operations, say arbitrage operations, by borrowing large amounts of money without posting collateral, using this money in order to undertake whatever arbitrage transaction they might want to take across two or more markets, pay back that money with a fee, and all of this is executed literally in a flash of an eye. Now, how on earth can one execute one of these without necessarily exposing the participants to either liquidity or credit risk? And the way flash loans work is there is a very important element of what is called atomicity. There is all the legs of the transaction have to be executed serially, and unless all of the legs of the transaction, that is borrowing the money, the repayment of the money, are all executed, the entire transaction fails. So now you have new financial products that are creating ways of undertaking transactions without the sort of collateral constraints that we have in traditional finance, and that can in principle get us away from the traditional risk that we're used to, credit risk and liquidity risk. But this is not to say that flash loans don't have their own problems, which I will talk about in a second. So we're in an interesting world right now where certain elements of risk that we are used to dealing with, that we're used to worrying about, can actually be dealt with, but it creates a whole lot of new risks. But that's not all that DeFi can do. There is this notion of permissionless composability, taking different open source products, combining them in a way that you create entirely new financial products. I've given you an example here of one where essentially you have a savings game where people deposit cryptocurrency. If you happen to have some Bitcoin or Ethereum lying around unused, you deposit into a loan contract, withdraw stable coins, put it into an interest-bearing instrument, except there is a savings game built on top of it. That is to say that not everybody who puts money into this interest-bearing contract gets interest. Basically, one lucky winner walks away with the entire interest payments and everybody else just gets their principal back. So these are cool. You might say, what is the practical relevance of these products? Now, again, these are not fantastical products. You can already get access to these products out there. But there are certain elements to DeFi that make it quite appealing. The fact that you have open source software means that you can rectify problems relatively easily. In principle, you can even plug in compliance tools. But the key thing to keep in mind here, of course, is that technology is not going to solve all problems. Certain types of risks may be mitigated. If you look at this very carefully, you don't eliminate it completely, although in certain limited types of contracts you do, but there are other problems. You have smart contract risk. You have the sort of oracle risk that Antoinette alluded to when you're trying to use off-chain data for on-chain products. But in addition, decentralized governance itself creates certain problems. My Cornell colleague, Ari Jewels, actually in a 1999 paper, devised the whole concept of proof of work. He did a very interesting experiment where he was looking at some of these protocols, and he and his co-authors found that there was a potential weakness in one protocol. Essentially, it allowed front running. That is to say, if the price of a particular open order for buying an asset, the value of that asset fell below that order price, before that order could be canceled, you could have a bot that stepped in, bought the asset, and fulfilled that order at the unfavorable price to the consumer. So what did Ari and his team do? There is nobody to report this problem to. So what they did, with the very best of intentions, was to write a blog post saying, hey, community, there is this problem. Let's go out and fix it. And sure enough, the community did go out and fix it in a few hours. But in those few hours, as he documents in his paper, there was a cottage industry of bots that arose precisely to exploit this flaw. So decentralized governance can cut both ways. And what is the problem here is not necessarily that this sort of front running may involve huge amounts of money, but the trust that is embedded in these systems is very fragile. And I think that's what we need to worry about, whether these sorts of attacks might undermine trust in the system. But a more basic question is, why do we need cryptocurrency or this new architecture? And I think there are some real issues with finance right now that we need to think about, broadening inclusion, improving payment systems, creating more competition, reducing the problem of economic rents. But I think DeFi, if we think about it as a solution, creates a whole set of new issues in terms of how we're going to implement and worry about the transmission of monetary policy, especially if traditional institutions like commercial banks are to be threatened. And as Gary has pointed out, that's not entirely obvious at this stage. But I think there are other risks related to whether the risks from this unregulated part of the financial system could undermine the integrity of the broader financial system. And finally, I think this entire discussion opens up a whole set of meta issues about what the role really is for governments and regulators in this area. One of the response of central banks, of course, is that they've been catalyzed by all the developments in terms of digital payments to start issuing their own digital currencies. But is that going to lead to disintermediation of banking system, perhaps inhibit private sector innovation and payments? I think are real issues we need to deal with. But ultimately, I think there are many benefits to be had from these innovations. The key question for enlightened regulators, at least, is how to get the balance right, how to make sure that you can facilitate innovation, but at the same time control some of these systemic risks. And if these sorts of financial products and services do get traction, we will have to deal seriously with the sort of issues that, again, Gary alluded to. We do have the Fed undertaking its lender of last resort function in a manner that is manageable because there are many important financial institutions connected to it. If finance is undertaken in a decentralized fashion by institutions, agencies that are not even obvious in terms of their structure, but are not directly connected to the existing financial system, how exactly would one deal with liquidity and other problems? And I think the final question is one that Anthony's paper poses, but it's something, again, that we're going to have to grapple with, whether all of these new financial products will really lead us to a better world where we have a democratization of finance, where even low net worth individuals have easy access even to bespoke financial products and services. Or we might end up, as technology often does, leading us to in a world where there is much greater concentration among financial players, among specific currencies on the international sphere, and we might exacerbate rather than mitigate many of the inequities we already have in our society right now.
Thank you, Eswar. We'll get that main screen up here. We have a question from Bob Hall. We'll start with Bob.
I did everything I could not to be the first speaker, but here I am. So I've been thinking that maybe all this Bitcoin stuff and cryptocurrency and so on is something that I should know about. And this paper just completely convinced me that that's not a good idea, because the last discussion really emphasized this point. It's all infinitely complicated, and whatever you do, there's someone is smart enough in Wall Street to work around it, and you have to introduce yet some additional form of regulation. But it doesn't have anything like the simplicity. But just to pull out a couple of things that really struck me, a smart contract is a substitute for something that works extremely well today, which is the form contract on the word processor of a lawyer. So if you're doing a startup or doing complicated estate planning or anything like that, your lawyer starts with a smart contract and then just smooths it somewhere here and there, fills in the relevant things, and boom, you're off. So most of the leverage that comes from this idea already exists on word processors. So that whole idea, the smart contract idea, doesn't seem to really go anywhere. The idea of stable coins, which is another thing that's pushed hard, this paper was very helpful to me. A stable coin is exactly a money market mutual fund. It's organized under the 40 Act, which has a beautiful architecture for getting things right. The notorious problem with money market mutual funds that occurred in 2008 and 2009 was a result of ignoring the provisions of the 40 Act. It permitted money market funds to try to be banks and stabilize what they paid out, as opposed to following the formula of the 40 Act. If the 40 Act had been obeyed, there would have been no run on the reserve fund. So this whole idea that there's some fundamental problem with money market funds is wrong. So it's a problem that's easy to fix, not hard to fix. So we don't need stablecoin. So what do we need? And I'm baffled now. I'm so glad I didn't bone up on this subject earlier, because it's a dead end.
maybe before we turn to Don Cohn, you guys want to take on, because Bob's asked sort of a big question is, what problem are we trying to solve? Antoinette or Igor, do you want to start with that? And the discussant should definitely jump in, and then we'll go to Don Cohn after that.
Igor, do you want to go? Shall I go?
You can start, or I can start.
Okay, so then, so thank you, Bob. So I think I would say the following. I think, it is still early days in crypto. So, and in particular, smart contract platforms might, in the end, have the potential to facilitate certain transactions. Like, we don't want to be caught in a world where we say, why do we need the internet? The mail system works really nicely. And isn't it great that we can write letters to each other because that expresses our emotions so much better than a short email, right? I mean, so you see, I believe that smart contracts, for example, right, just, might, like you said, it might be the opportunity to execute very simple contract at scale in an open way. Maybe when you write kind of a simple enforcement of a contract with your plumber or something like that. I think, but you're right that I think many of those things don't need the permissionless part and the anonymous part of the Bitcoin blockchain, right? In fact, that's what we were even trying to point out, and that, a lot of the benefits could be even in permission blockchains or in basically when validators work and are regulated by, by society. I do want to say one thing about smart contracts, right? Because remember, they are self-executing. So once, and we spent a lot of time in the paper on this, right? But once they basically get set in motion, you can't stop them anymore, which means basically they push you into a world where you have to complete contracts ex ante because you don't get ex post remediation through the legal system. And while I think for many things, we don't like this at all, right? Because we want, say, a disadvantaged party to be able to go into, kind of legal, kind of complaint or kind of be able to be made whole in a fraud, right? There might be some applications where actually being able to opt out of the legal system could be, kind of a self-commitment mechanism, or could be a way to reduce some legal costs. And I don't want to rule out that couldn't have some applications. So I do think smart contracts in particular, kind of could in itself be quite interesting. For the rest, I think the jury indeed is still out. And sorry to go on and on, but I do want to say that these externalities on systemic risk and also kind of, on tax evasion and other fraudulent activities, I think we should, I don't know if you want to bone up on them, but I think we should be able to resolve them so that they don't undermine our system.
Well, we have a breakout period coming, right? So we can
We
continue
do.
this discussion there.
We can follow up in the breakout session. Don Cohn had a question. Don, why don't you go ahead?
Great. Thank you, Jan. Really interesting paper and discussion. And I want to focus on the second to last bullet on Eswar's last slide, which is the financial stability stuff. And so I get it about stable coins, and I agree with Bob Hall. It seems like you ought to be able to somehow deal with that issue. But Antoinette, you talked about leverage, and both Eswar and Gary hinted at credit getting involved using these things. And I wondered what would happen in a March 2020 flight to liquidity, dash for cash, in a distributed ledger DeFi world. Is such a thing possible? That is there enough leverage and maturity transformation to cause a run and fire sale type issue? How would the central bank intervene in such a situation? I guess a little a little more thought on that or a little more explanation of that would be helpful. Maintaining financial stability beyond the stablecoin issue.
Somebody want to pick that up?
Sure, I can try to scratch the surface. What we show in the paper, there are different types of actually stable coins, and I guess Eswar and Gary, they mostly talked about stable coins which are backed by some traditional assets, and in particular some liquid assets, at least in theory. There are also stable coins, algorithmic stable coins, which are not backed by anything. So in principle, kind of they work along somewhat different mechanisms. So, but if we talk about what will happen if there is like flight to quality or something, actually there was some cases already in the crypto space when, for example, the price of Ethereum declined by 60% or 70%, and then we had quite a lot of contracts and stable coins like DAI, which was over collateralized, like that coin was used as a, that system works kind of where collateral is built on using the Ethereum coins. And then what we saw is that, yes, that somehow there was this amplification effects where the price of Ethereum declined, and then lots of collateral, lots of contracts got executed and unwinded, and then the price of Ethereum even further declined. So yeah, there would be this instability, and probably to deal with it, we would need some either interventions and the ability to inject liquidity if we want to preclude those type of events.
Yeah, I think it's a very serious concern, Don. So the algorithmic stablecoins that Igor referred to and which are described nicely in the paper are essentially collateralized by the values of other cryptocurrencies, whereas the sort of traditional stablecoins are collateralized with ostensibly liquid assets. So many of these instruments are in principle collateralized or over collateralized. So it's not the traditional sort of risks that a fractional reserve banking system might be subject to. But I think the real question is a crisis of confidence. You know, if people start getting worried, perhaps because of one of these events that I mentioned, or perhaps because of attacks on nascent blockchains, you could quickly undermine confidence in these systems, and then you'd have to run towards a redemption of what are in principle liquid assets, but the sheer size of these redemption requests, given how large some of these markets are becoming, could end up creating exactly the sort of problem that money market mutual funds did in the global financial crisis. And the problem we would have then is that we don't have any obvious conduits in which to funnel liquidity into the system as a backstop, simply because these are decentralized, non-traditional financial institutions. So while I think there is a lot of promise here, I think we need to worry a great deal about whether these things are getting out of hand and whether we have adequate protections in place to prevent them from spilling over into the traditional financial system.
Maybe that's a place to pick up the rest of the discussion, which is, where do you see the policy agenda going in this space? There's been a lot of individual issues raised, but if you were going to start somewhere now, given that the space is growing so quickly, where would you start? What would you recommend that policymakers do? That's an open question to anybody on the panel.
I think the Treasury's President's Working Group got it right. Stablecoins are banks, and what they issue is short-term debt. That raises a question that we haven't had to think about for about 150 years, which is that every nation on earth has decided that the government should be the monopoly supplier of money. And it's too late to even think about that question because the lobbyists for stablecoins are already too big. So the second best ought to be declare them banks, and they should be regulated as banks. And they can even be insured, right, for the limited amount that's, you know, you can insure on the account. And we'll see if that happens.
So I think it's worth re-asking the question that Bob Hall correctly asked, why do we need cryptos or DeFi? And there are certain issues, I think, in terms of the functioning of the modern financial systems that I think are worth thinking about. You know, the lack of financial inclusion. Even in the US, about 5% of households remain unbanked or underbanked. So you and I can easily use Google Pay or Apple Pay, but you have to connect that to a bank account or a credit card. You know, countries like China have gotten way ahead of us in terms of digital payments. We still have many inefficiencies here. International payments are racked by inefficiencies. So in terms of improving payments, I think there is much that can be done. Then there are, you know, elements of concentration and inefficiencies in existing financial systems. So as one looks at the variety of problems that beset financial system, and of course, Gary, Antoinette, and so on have written extensively about these issues. It's worth thinking about whether these new technologies actually do lead us to a path whereby these will be resolved. But at a minimum, and again, this is referred to in the paper, what these technologies have done is to catalyze some change that I think can be ultimately good in terms of improving payment system. You know, one can just think about these as providing competition for fiat currencies and their medium of exchange function, perhaps even in their store of value function. They've really catalyzed significant improvements in international payments, which are coming down the pipe. But the key issue is whether we have the right sort of guardrails in place to make sure that this stuff doesn't pick up so much momentum and becomes a big financial risk of its own. But I think the good thing about this digital revolution is that it's forcing us to, you know, step back and think hard about what problems need to be solved. And some of these we've sort of accepted as just part of the system, and maybe we should be rethinking them.
We have questions from Olivier Blanchard and Daniel Tarullo. So we'll start with Olivier and then Dan.
A quick follow-up to something that Gary said. Treat them as banks, treat stablecoin issuers as banks. Are there technical issues, or is it just a question of fighting the lobbies?
I'm not sure I understand the question. I mean, there's a very large lobby, and there's a kind of sentiment in Congress that, you know, we don't want to squelch innovation. And so there's no technical issues, because with stablecoins, it's not easy to redeem them for cash. But what could easily happen is you just go sell it and the price drops to zero, which we saw with Iron's titanium coin. So it's not, you know, going to be a financial crisis quite yet. I suspect when we get the financial crisis, then we'll start to think about it. Maybe that'll happen in, I don't know, 10 years.
Dan Tarullo, you put your hand down. I don't know if that means you're ready or that we answered your question.
Just that you recognize me. That's why I put it down.
Oh, okay, good. Go ahead.
So I think Don Cohn and I are probably thinking along the same lines on the financial stability issue. So I wanted to reformulate his question a little bit for Gary first, and then in a different way for Antoinette. Gary, do you see any, other than in stablecoin, do you see any significant leverage cum short-term funding that would kind of give you an echo of your repo concerns, or is that really at this point pretty insignificant? And then for Antoinette, is those governance problems that you focused on seem to be the sort of thing that maybe like the SEC should be working on more, because those are the classic kind of intermediary governance or corporate governance issues, as opposed to the prudential regulators. And I wonder if you think that is actually the path that we should be going on that set of issues.
I don't think that the leverage in the borrowing and lending is a systemic risk. A lot of that is done with fiat crypto. All that could go to zero and it wouldn't be a systemic risk. The systemic risk comes from the short-term debt, which is from stable coins. And the fact that they already have an impact on the commercial paper market gives you a sense of how big they are, even though when you look at the numbers, they're only about 180 to 200 billion outstanding. So those guys are the concern. And we've already missed the boat on them in terms of, outlawing them the way China has. And so, my concern is they're going to grow, and, they probably won't be regulated until there's a financial crisis. I mean, I don't ever testify in Congress, but I've talked to the Senate Banking Committee staff and House Financial Services Committee staff. Those are the people I talk to. And I get the sense that we're not going to go far on this in Congress.
Let me say, to the point of governance. So you're right that, kind of in a narrow sense, the, kind of the governance issues obviously are issues for the SEC, but, kind of what I was, also trying to explain is that some of the, say, decentralized autonomous organizations that are trying to be completely on-chain, you don't have recourse to the legal system because by design, they don't want it, right? And so then if everything is on-chain, you don't know who is who. And even if some minority shareholders do get defrauded, right? Who can they turn to? Because, kind of, at least in the current system, kind of they don't benefit, say, from fiduciary, kind of the legislation of these organizations is not that say majority shareholders have fiduciary responsibilities vis-a-vis others. I think, kind of I would say parallel to what, kind of Gary just said and Esva had, kind of also talked about. So to me, in addition to the systemic risk, I do think we should not forget the fact that you can have major, kind of problems with tax evasion, with, kind of basically bad players entering our financial system if we don't solve this, kind of pseudonymous and permissionless aspects of these blockchains. And I do think while this is not an immediate systemic risk, right? And ultimately, it means we have to give up collecting taxes because any firm that is not on the blockchain, if we allow this thing to persist, has an immediate, whatever, kind of 30% tax disadvantage vis-a-vis things that are just tax exempt. And same for collecting taxes from individuals.
Okay, I'm going to draw us to a close with that. Thanks to the authors and the discussants for their presentations and for this follow-on discussion. You should have all gotten an email just about 10 minutes ago that has the links for the breakout sessions. So there's a breakout session for each of the papers today. So you should just be able to click on the link and so log out of this session and then click on the link. It'll take you to another session where we can have smaller group follow-ups and discussions about each of the papers. So thanks everybody for participating today. Remember, we pick up again tomorrow morning. We've gone back to our 2-day format. And when do we pick up tomorrow morning? At 10 o'clock Eastern time with a panel on fiscal policy and budget deficits. Okay, thanks everybody. See you in the breakouts and tomorrow morning. Thanks.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.